shutdowns, but we were really close. And that is a leverage point that the Chinese have in any negotiation. And again, whatever your view is on the relationship with China, whether it's, sort of going to be a collaborative relationship moving forward that gets reset or something much worse, we need to take this leverage point off the table. That's our view at MP. That's what our mission has been. We've been at this for years, is let's make sure that the United States of America can produce our own rare earth magnetics. And the reason, Joe, that is so important, and you mentioned DOD, is because as we've seen around the world, physical AI is the future of warfare. We're talking robotics and drones, and I think we see that from whether it's Elon Musk or Jensen Huang talking about the scale of robotics and how large that industry is going to be. It is not acceptable for American companies downstream. We're talking about trillions of dollars of enterprise value, our great leading companies, as well as our Department of Defense, to be reliant on a single point of failure in the Chinese supply chain. And so we serve a critical role in alleviating that risk.
All right, so it sounds like you're making the argument for why the U.S. government should be involved, but is the government, U.S. government, is there appetite for the U.S. government to be a partner in rare earth projects and doing it from A to Z, from mining to processing to permanent magnet production?
There is no question that the United States government recognizes this, and I think that these things take time, but there's no question that they recognize, and Joe was referencing our perspective on the earnings call, which is this is actually very doable. We are, in a very short period of time away from solving this challenge in a large scale. And frankly, MP can lead that effort. And what we said is that MP, we've been at this for a number of years. We've invested over $1 billion of private capital, and since we went public. And then prior to that, we had the good fortune, I guess, of taking control of several $1 billion of previously invested capital. So we have billions of dollars of invested capital. And what we've said is, we'll lead this solution, but it's not fair on our shareholders to expect them to take the risk. We're going to need to do this in a capital light way for MP.
Right.
It should be very rewarding for our shareholders for being in this position. So to answer your question, there will be movement forward, in my opinion. I think it's a question of these solutions don't happen overnight, but there's no question that there are a lot of conversations happening with government and industry, and we're leading those.
Okay, so it sounds like government's involved, they're listening, and we should maybe stay tuned for news. What kind of money is needed to be committed to do the proper build out in your view, whether it's public-private partnership? And just about 30 seconds on that.
Yeah, the really simple answer is we're talking single-digit billions. This is a really simple problem to solve, actually. I jokingly say for the coffee budget on the F-35, we probably could have solved the rare earth issue. This is really small.
Wow.
And so I do think the United States government is going to step up. I think you're going to see industry players step up as well, because this is it's an issue that affects our national security and trillions of dollars of enterprise value, and it's actually a small problem.
You mentioned that we could do this in a short period of time. Give us years or some sort of timeline that we could actually move away from a single point of failure when it comes to this problem.
Well, we're bringing that online now in Texas, right? So where I'm sitting is a factory. You all are welcome to come see it. And so we'll be making magnets at scale here at the end of the year. And then the question is, what percentage of the industry do we need to satisfy to remove the single point of failure risk? Because we don't need to solve 100%, but we need to do a material percentage. And so I think the next step would be for us to lead a solution where we're building, something significantly larger, and then, rinse, repeat to add a number of facilities, both here and as we announced with the MOU, potentially in the Saudi Arabia and other places. So it really is not a huge issue. It's just an issue that requires capital and execution.
Right, and I think on that point, it's not just going to be you. It does still require a lot of other actors to come into this space. And I guess the quick follow-up again is, what are we going to see from the government this year in terms of commitments to help this space, your company and others, build out the supply chain on rare earths and permanent magnets?
Well, just to be crystal clear, as we all know, the capital markets can satisfy this problem if the existential issue of the industry is off the table. And the existential issue is Chinese mercantilism, right, is pricing. We've got to get proper functioning economics, proper functioning market economics for the price of these materials and the price of the downstream products. And so there's a variety of ways that the government can force that solution. You've heard a lot of them in the news, and certainly we're working on them. I think you'll see a variety of things across investments, tariffs, tax credits. And so there isn't, sort of one fits all solution. It's really going to be a question of the preferences of government. And certainly you'd have to get some of them on here to ask them directly, or stay tuned for, a solution that you see us present one day. But I do think we're going to see something, sooner than later, because we've got to solve this problem.
Yeah, no doubt about it. Jim, really cool. I know we're going to be coming back to Jim Litinsky. He's co-founder, chairman, CEO of the rare earth mining company. So much more than mining, as we know, MP Materials. And of course, our thanks always to Joe Doe, Bloomberg News metal mining heavy machinery reporter. You said we had to talk to him. We did. Good stuff. Thank you. Thank you. All right, folks, let's get back to the market. Yep, stocks are down, but we've also seen yields move up. We're going to talk about that in just a moment. But first up, let's get to Charlie with an update.
Thank you very much, Carol Master. That basically sums it up. I do want to begin with a pair of developing stories right now. The Walt Disney Company suspending Venezuelan workers after today's Supreme Court ruling. Also, the U.S. Defense Department has accepted that Boeing 747 from Qatar for President Trump's use. Stocks lower across the board. Wall Street worrying about a ballooning deficit. Right now, we have got the S&P 500 index moving lower by 71 points, down 1.2%. The Dow down 701 now, down 1.6%, close to session lows. We've got NASDAQ down 183, drop there of 1%. 10-year 4.58%, the 2-year 4.00%, the 30-year 5.07%. Gold up 0.7%. West Texas Intermediate crude down 0.8, and Bitcoin did see a record today. Right now, little changed on the day, 106,909 on Bitcoin. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. 30-year yield starting about 5%, sign of dimming investor demand. We've been talking about this a lot. We saw the move. Equities came down, but it came after that Treasury auction, $16 billion Treasury sale, lackluster demand, moving yields up along the yield curve. But it turns out, Tim, investors are worried about a ballooning deficit.
Yeah, look no further than what's happening on the long end as we speak, with yields higher by 10 basis points right now. Michael McKenzie is rates reporter for Bloomberg News. He joins us here in the Bloomberg Business Week studio. We were in here on Monday when we spoke about the 10-year briefly, or the 30-year rather, briefly hitting 5%. We've blown past that.
Yes.
What's the signal that's sending? Is it about the spending bill? Is it about the tax bill?
I think a lot of it's due to that. I think it's really interesting on a day when stocks start to take a hit. You don't see really any pullback in the sell-off in treasuries. The other interesting thing to observe today is that the 10-year briefly got above 460. If you think back to last month when Scott Bessent stepped in and told Trump, hey, let's do a 90-day delay on tariffs because we're just hitting with close to 460 on 10s. We edged above that just now. And again, you can jawbone the market once, but if you then step back from all the tariff chaos of last month and the highs we saw then, today it's about the deficit. Today it's about a Congress that really doesn't think it needs to be fiscally disciplined here. And the bond market is telling you that, and it's not just the US story. Japan had a 20-year sale this week, very badly received. You're seeing 30-year yields in the US, Japan, UK, Netherlands, all pushing higher. And this is a global revolt that is beginning to take shape here, where investors are saying, if I don't need to own long-dated bonds, I'm not going to own them. And that's why when I was talking to investors today and yesterday, they like being in the front end of the curve. They like being between 2s to 10s. They don't really like the 30-year at all. So if they have mandates that say, please buy these bonds, they try not to, but they do buy some. But at the end of the day, they're negative on the long bond, and they probably have these steepener trades on where they're basically owning 2s and 5s and selling the 30-year.
So does this have to do with, I kind of always go back to this, Michael, certainly yourself, a lot of folks at Bloomberg, a lot of people on Wall Street kind of get the Treasury trade, right, when things are happening. But I do think about the world at large and what it means. Is it U.S. non-investable? Is it just a sign of concerns about the ballooning debt and what it means maybe for the government and spending and entitlements and how it plays out in the economy, what it does to economic growth if there isn't government money to commit to programs to kind of help? So that's
what we're beginning to look at here, because I think what you're seeing here is, if you look at developed world countries, they have aging populations. there is a much greater need now for retirement and medical costs. If you look at the issue with the US budget at the moment, they don't really want to start attacking and reducing the entitlement spending now, because it's just such a huge vote loser. You can understand why Congress doesn't want to do this, but at some point, taxes will have to go up. You can't say, oh yes, we're looking for sources of revenue. This administration is looking for tariffs. They're simply not going to get enough revenue from tariffs that can sort of offset the plans for cutting taxes in the future. Then we're already starting at 100%. The deficit, the federal debt is 100% of the economy. It's the same in the UK. It's 200% in Japan. So again, investors are looking at the world and going, well, I would rather lend to AAA rated corporates. I'd rather lend to companies that actually don't really need to borrow and probably only really borrowing in order to fund buybacks, rather than to really well-established countries like the UK, like Japan, and certainly the US falls into that boat, unfortunately. I mean, and I think the other thing that's concerning is that when I was asking people this week, okay, we get 30s above 5%, is that worth the trade? Not necessarily anymore, because again, there's this real trepidation now in the bond market at the margins. They're saying this Congress deal on the budget just isn't really making any sense. It's not going to alleviate the problem. So do we need to send a bigger message to Washington? This is an issue. And you guys are kind of walking past the graveyard and just whistling along.
We asked our Eric Wasson, congressional reporter up on the Hill, watching this big, massive, big, beautiful bill make its way through Congress. He said, despite what you might be hearing from the White House, it's a deficit increasing package. And so net, folks, it's going to add to the deficit. Michael, thank you. Really appreciate it. Checking in on that Treasury trade. Our own Michael McKenzie follows the rates market here at Bloomberg News, joining us here in studio.
Well, looking for outperformance in today's equity trade, and really the equity trade for the last year, check out the more than $23 billion market cap language learning app. It's the most popular in the world. We are talking about Duolingo, the stock up 60% year to date, up around 200%, Carol, in the last year.
Yeah, and you know a lot about this company. You actually talked with our next guest. Delighted to have with us the CFO of the company, Matthew Scarupa. He is Chief Financial Officer of Duolingo, joining us from Pittsburgh. He is featured in the upcoming episode, as is my co-host, Tim Stanovic, Chief Future Officer. It's on Bloomberg Television this evening at 9:30 p.m. Wall Street time. I got to say, first of all, Matt, nice to be talking with you. Tim hosted the episode. He's been talking about you and the company so much. I mean, you guys are on fire. Talk to us about the growth at the company, where it's coming from, in an environment that there's a lot of pressures on companies and leaders at this time.
Well, it's great to be here. Thanks for having me. And you're absolutely right. We've done a great job of growing this year. Our Q1 performance was strong top to bottom. We saw really strong user growth. That user growth translated into really strong top line and bookings and revenue. And we were able to, keep control of costs like we historically have been able to expand margins. And it wasn't just a Q1 story. As we guided on our last earnings call, we believe we're in a really strong position for the rest of the year. We feel good about Q2 and the rest of the year. And it's going to continue to come from the same sources. We're a company that grows primarily organically by word of mouth. And we expect that to continue.
Hey, Matt, good to have you join us. Thanks for doing this today. And thanks again for participating with us for the CFO show. It premieres again tonight. 10.3 million paid subscribers as of the end of the first quarter of 2025. It's growth of 40% year over year. How long can you continue that growth? I mean, when we're talking growth at that percentage, that's pretty substantial.
No, I appreciate it. It was great to do the show with you, and I look forward to seeing that. In terms of growth, we've done it for several years. I mean, we went public in 2021, and if you look back from then to now, we've grown the top line really nicely. So I'd say that, you look back and you think that we have a strong path going forward as well. I'd also just call out that the 10.3 million subs is great. We're excited about that. We feel really good about that growth. But we're also seeing really nice diversification of subscribers. So we have continued strength in our family plan, which is a subscription where multiple friends and family can join. And as of the last quarter, 7% of our subs were on our max tier, which is our highest tier service, which has features like video call with Lily, and it's doing really well. So it's a great story, not just on the overall top line numbers, but on how we're growing the subscribers.
I mean, that's wild. Almost 50% year-over-year growth, Matt. I am curious, who are these people that are signing up? How long do they stay with you? And what's the cost to acquire an individual user?
Yeah, so our one of our core business model advantages is that when we acquire a user, we acquire them mainly for free. We do spend on performance marketing and some brand spend, but it's relatively small as a percentage of revenue. And so most of our growth comes from people telling their friends and family that they've had a great and engaging experience with our app. That's why Luis is so focused on engagement as a core driver of growth for us, is that if you have this wonderful, joyful experience, you're going to tell people about it and they're going to try it. And then the other way is we have a really amazing social-first marketing strategy where we insert ourselves into viral moments online, TikTok, Instagram, and other platforms. And users create their own content, which goes viral. And so on any given day, a lot of what people are talking about on Duolingo isn't generated by us. It's generated by our, beloved fan base. When you have that type of user acquisition and it is global, we're seeing strong user growth around the world. We get a lot of opportunities to then convert folks from free subscriber to paid, or from free user to paid subscriber. And they stick around on the platform and they come back frequently. And so we get multiple chances to convert them. And while while time is progressing, we're making the subscription product even better and better. So that's how we grow the subscriber base.
We'll talk a little bit in a minute about the social first marketing, because something kind of wacky seems to be happening right now if you look at the social channels for Duolingo. But I'm wondering specifically, Matt, about growth and about, at the end of the day, the efficacy of the product. And I'm wondering how you measure to what extent the product actually resonates and works for people who are trying to learn English as a second language, for example, to be able to do business in the US or to be able to do business in English. How do you measure that?
Yeah, well, it is core to our mission. So our mission is to, build the best education in the world and make it universally available. And so to do that, we need to prove to our users and to ourselves that we're teaching really well. We've had some studies done that show just how efficacious we are. So, if you compare us to learning a language in a university, we are on par with that. You can probably do it faster on Duolingo. And, there's plenty of evidence we put on our website that shows those studies in detail. I think the bigger evidence is that we're continuing to add features that just really address some of the core desires of particularly English learners, like you referenced. They want to practice conversation. And so what we've done over the past, several quarters is add this feature called Video Call with Lily, where you can practice your conversation with one of our characters, Lily. She's a bit passive-aggressive. She's not impressed. I've yet to impress her with my Spanish, and I don't think I'm going to, but I'm going to keep trying, which is the thing. And
I just want to say she's over your right. Well, we're looking at pictures of her on the screen right now. There's also she's next to Duo over your right shoulder. So Carol, that's Lily, who's not impressed. Who, by the way, in the last couple of months has unfortunately become a member of my family, it seems like, with doing this with our kids.
I just love that she's passive aggressive.
Yeah,
Bring it on.
Yeah, Lily is not impressed with me. And so that kind of practice, though, is really helpful for folks who are trying to learn English. They're trying to learn how to speak it. And that's what we've been able to do over the past little bit.
So you use AI in a few different ways. Lily's certainly one of them. When you think about the cost associated with this, you're not using AI, a platform that you developed actually at Duolingo. You're outsourcing the technology. How do you keep those costs in control? Because that's pretty expensive tech, Matt. And you're watching the bottom line and you're watching margins here.
Yeah, absolutely. And, it comes down to the fact that we have been using forms of AI, machine learning and whatnot for a long time in our company. The lesson you get served up, has for many, many years been based on a machine learning algorithm. And now with generative AI, with Video Call with Lily, and in some of our content creation, we are seeing that there's an amazing advancement in this technology that helps us do these things much quicker and more, even producing more content than we thought was possible. For example, it took us about 10 years to create the first 100 courses. And then in less than a year with this new technology, we created more than 100 more. And so this technology is really powerful. The good news about it is that the costs are coming down naturally. We don't have to do much internally, although we are still doing things to optimize the costs. But just by the nature of this technology, we're seeing rapid declines in the cost. And we don't know for sure that that's going to continue, but if it does, I think that the use of this will go up and margins will be good.
I just want to know, I'm 100.
Sure. Well, I don't know that I've ever met anyone else or talked to them live on air, but I am also Slovakian, which is quite the coincidence.
Whoa.
But I think, yeah, it's a very nice coincidence. It turns out more will depend on your ability to put in the time. Learning a language takes practice, and that's why we're so focused on engagement. We want you to enjoy our app and come back every day because it's going to take time to learn. So if you're really committed and you want to learn any language on Duolingo and you put in a bunch of time, you're going to learn it much faster, and that's what the research shows. And so it's really motivation dependent. What we find is that the hardest thing about learning a language isn't verb conjugation or grammar or speaking. It's your motivation to keep practicing and keep learning. And that's why most of our company is geared around bringing you back every day and making sure you're engaged in the product. Because if you're engaged in the product, you have a chance to continue to learn.
Yeah, the gamification, the alerts,
totally
the
get it.
emails,
Yeah.
like the friend streak, all the stuff that brings you back into the program. Matt, I promised that we'd go to this unhinged marketing and social media strategy because you got to shed some light on what exactly is happening across Duolingo's social channels right now. I checked in on it yesterday and this morning, and it looks like Duo has been taken hostage. There's like some sort of hostage video. Everything else has been wiped. What can you tell us?
Well, I can only tell you that our owl is truly unhinged. You can never predict what that guy's going to do.
Sounds like my co-host. I'm just going to tell you, Matt. Never know what he's going to do. Anyway, go ahead.
I've only spent a little bit of time with Tim, but I kind of can see it.
Love it.
Our owl mascot earlier this year, right after the Super Bowl, decided that he was going to fake his own death and then return. And so you just never can predict it. I would just encourage everyone who's watching and listening to check in again tomorrow. You'll get some interesting insight.
All right, there it is. Matt Skarupa, Chief Financial Officer over at Duolingo. Matt, thanks for joining us. Good to see you once again. Chief Future Officer with Matt premieres tonight, 9:30 p.m. Wall Street time on Bloomberg Television. You can also check it out online and everywhere you watch Bloomberg TV.
Looking forward to it. You've been talking about this for a long time. Hey, right now, though, at this moment in time, everyone talking about what's going on Wall Street. You've got the S&P 500 a leg down near its lows of the session, so it's down about 1.5%. The NASDAQ 100 a decline of about 1.2%, 257 points to the downside. Clear move to the downside. You've got the Dow Jones Industrial Average, a decline of almost 790 points, down 1.8%. The concerns, again, we talked about this with our Michael McKenzie. It's about that ballooning deficit. We've got a major spending and tax bill making its way through Congress. Pushback, yes, but the big thing is, bottom line, it's going to add to the national deficit, and the government is certainly adding on to that, it seems, in this new package. We also had a Treasury auction that reflected the concerns by Wall Street, a $16 billion Treasury sale, lackluster demand, and so investors are pushing back. And basically, our Michael McKenzie saying, hey, Wall Street, you want a little bit of a message? Here it is. We're not so keen on some of these Treasury auctions because of the concerns about what's going on in Washington.
Well, speaking of stocks and the market, let's take a look at some stocks on the move today. I'm Tim Stenivek with Carol Massar. We're joined by Bloomberg News cross-asset reporter Denitsa Sakova. Denitsa, what's on your radar?
Let's start with United Health. We've been talking about some of the stocks being down today. That's definitely one of the big movers lower. We saw it fall as much as 6.7%. There have been so many negative news about the stocks lately. Today we have a report by The Guardian that the health insurance secretly paid nursing homes to to reduce hospital transfers, and nursing home residents who needed immediate hospital care under the program failed to receive it, and there was actually interventions by United Health staffers. This is reports so far. We had another report of investigation about Medicare fraud. We also had the company cutting and then suspending its annual forecast. So it feels like a year of bad news coming in just a couple of weeks. But it's very interesting that the company in February had just one sale rating. We had an amazing story on the terminal that United Health was one of the highest rated companies in Bloomberg, but now it's down 40% year to date.
Yeah, it's remarkable to see what's happened in such a short time. Canada Goose kind of moving the other direction.
Some good news there. It jumped 24% today. It's very interesting as we see the tariff impact unfolding. New winners and new losers emerge. With Canada Goose, it's very interesting because it manufactures 75% of its products in Canada. Nearly all of those comply with the standards of the US-Mexico-Canada trade deal, and therefore they'll be exempted. They have some exposure to goods that are manufactured in Europe, but they said that that's not that big of a thing. The main thing that is really clearly lifting the stock today is that they say the minimal impacts of tariffs on obviously that high-end consumer when it comes to that. And this is a brand who sells $1,500 parkas.
I know.
So it's a
I
good
heard
sentiment.
John Tucker talking about
Carol?
those $700 vests. Yes, I have heard.
Yeah.
Target. Let's talk about Target. Just got about 30 seconds, down about 4% today.
Yeah, that's not so good consumer confidence metric there. It cuts its sales forecast. We're seeing a sharp pullback in spending. Of course, that company, there have been many issues. There have been boycotts. There is the consumer part, and the CEO is actually facing a lot of pressure to recapture growth. It's been 2 very difficult years. The company is down 30% year to date. It's very imposed to tariffs. So that's one thing investors are looking at. But a lot of pressure for the stock for sure.
So appreciated. All right, for more Stock Movers podcast, 5-minute episodes, you can find it, Biggest Winners and Losers, on Apple, Spotify, or wherever you get your podcasts. Hey, folks, if you're watching on TV, the close coming your way in just a moment. Tim and I continuing on Bloomberg Business Week Daily right here on radio.
CBS News on the Hour, sponsored by O'Reilly Auto Parts.
I'm Cammie McCormick. There was another contentious meeting at the White House between President Trump and a foreign leader, this time the president of South Africa. Linda Kenyon reports.
It started with niceties about expanding trade. Then President Trump surprised South African President Cyril Ramaphosa with a video designed to support claims of genocide against white farmers.
Those people were all killed. Have they told you where that is, Mr. President? No, I'd like to know where that is, because this I've never seen.
President Ramaphosa stayed calm, but pushed back, saying the killing of white Afrikaners is not government policy.
This is precisely what we would also like to talk about.
He then turned the discussion back to trade and investment. Linda Kenyon, CBS News, the White House.
Defense Secretary Pete Hegseth has accepted the Boeing 747 that Qatar offered to President Trump for use as Air Force One. It's valued at hundreds of millions of dollars, and it's raised constitutional and ethical questions as well as security concerns. A federal judge says the Trump administration has violated a court order on third country deportations by sending migrants on a possible flight to South Sudan. Tricia McLaughlin of the Department of Homeland Security says the 8 migrants were criminals.
No country on earth wanted to accept them because their crimes are so uniquely monstrous and barbaric. These heinous individuals have terrorized American streets for too long.
The Justice Department is moving to cancel settlements with Minneapolis Minneapolis and Louisville that called for them to overhaul their police departments after high-profile killings. Scott McFarland has that.
Louisville was accused of excessive force, including excessive use of neck restraints, police dogs, and tasers. Minneapolis has been under scrutiny from the feds ever since the murder of George Floyd.
The Justice Department had already decided not to enforce the settlements. A House panel met for several hours early this morning, but there's still no agreement on President Trump's budget plan. Tarian Small reports.
It appears, and this is according to Chip Roy, the congressman from Texas, that they're still not all the way there yet. Chip Roy and other members of the Freedom Caucus are begging the speaker to consider pushing the timeline back a bit so more of these conversations could happen.
The vote was hoped to happen tomorrow. Parts of the South recovering from another night of severe storms and tornadoes. This man in Arkansas.
There was not any warning at all through the phone. Usually I get a phone message with a beep on it. Happened so quick, nobody knew it.
On Wall Street, stocks have been off all day. The S&P 500 down more than 1.5%. The Dow Jones Industrials currently down 755 points. This is CBS News. Salt and Peppa is suing for the rights to their music. CBS's Stacey Lynn reports.
The lawsuit alleges that Universal Music Group is violating copyright law by refusing to turn over the rights to their master recordings and even pulled their music from streaming services. Cheryl Salt James and Sandra Peppa Denton filed the suit in federal court in New York, asserting an old copyright act that lets artists take back control of their music 35 years after signing away the rights. UMG maintains that the recordings were works made for hire, which would not allow for them to be reclaimed. Stacey Lynn, CBS News.
You hear a lot these days from President Trump about critical minerals. Now, a new report claims the world's supplies are increasingly concentrated in just a few countries, most notably China. And that leaves the global economy vulnerable to supply cutoffs. China is the leading refiner for 19 out of 20 strategic minerals. I'm Cammie McCormick, CBS.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Massar and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
All right, folks, we're back to this. Yep, worries on Wall Street. You can see it. Equities moving down. You've got Treasury yields moving up. That's really the big story here today. Wall Street, and I should say investors, concerned about this big spending package basically making its way through Congress. Not signed, sealed, and delivered yet, but it will add to the deficit, and that has investors worried. And so we didn't have such a great Treasury auction earlier today, Tim.
Yeah, Gina Martin Adams is in the house. She's going to be joining us on everything we need to know about what's happening in the equity trade. And also, we're going to ask her, about what's up with the bond market. Also, speaking of what's up with Target, Carol?
What's up with Target? Yeah, that's what we're going to get into. We've been talking about the retailers all reporting earnings this week, so we're going to get into that in just a moment. Stock's down about 4%. What you need to know about the company and what it says about consumers.
All that and more. First up, though, a check of the day's trade and top business stories. Here he is, Charlie.
Thank you very much, Tim. Here's what's going on. Stocks are sliding. 54 minutes to go ahead of the close. That weak Treasury sale lifting U.S. yields. Whole lot more coming up in just a moment with our Gina Martin Adams. And here's where we stand. We have got the S&P 500 index down 88 now, down 1.5%. The Dow lower by 775, down 1.8%. NASDAQ slumping 250, down 1.3%. The Russell 2000 small caps being hit hard today with the Russell 2000 index down 2.6%. 10-year 4.58%, the 2-year 4.00%, the 30-year 5.08%. Gold up $30 the ounce, up 0.9%. West Texas Intermediate crude down 9/10, 61.46 a barrel, and Bitcoin right now up 0.1%, 107,109. Did see a record today on Bitcoin. Briefly, United Health Group tumbling 5% after the Guardian newspaper reported the insurer secretly paid nursing homes bonuses to reduce hospital transfers for ailing residents. Medtronic plans to separate its diabetes business into a standalone company. Medtronic down by 2.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie. Really do appreciate it. As we mentioned, we've got with us Gina Martin Adams because we're looking at equities right now, down 1.6% on the S&P 500. Also, the yield on the 30-year up above 5%. Gina Martin Adams is Chief Equity Strategist for Bloomberg Intelligence. She joins us here in the Interactive Brokers studio. Gina, the move today, as Carol reminded us, in equities happening right at the time that we saw a weak bond auction.
Yeah.
How do you look at something like this in the context of a spending bill that's making its way through Congress?
Yeah, I mean, I think that Carol spoke about it earlier, pretty much right on the head. We're a little bit, the bond market is concerned because we're reaching the debt ceiling. We're going to spend even more money. It's just really difficult to justify owning bonds in that kind of environment to the degree that you would have yesterday, the day before, a year ago. And that certainly is creating some risk, peripheral risk to the equity market. Now, remember, the tariff risk also played out through the bond market, right? When the bond market started imploding, the stock market then was imploding, President Trump pivoted. So let's see what happens with the bill on account of the bond market pushback, if it continues. I don't think one day makes a trend, and I'll defer to Ira Jersey as to whether or not this is a game-changing day or not. But I do think you want to watch the bond market as the primary source of risk and movements in the broader financial markets right now, including the equity market.
But how do you think about, okay, so let's say we do get a massive spending proposal, and we were talking about, so what does that mean if we have a higher rate environment? That puts pressure on everybody, right? And on the economy. And that ultimately will play back, right, in terms of maybe earnings or what the corporate financial pictures look like.
Yeah, I mean, it depends on what is in the package. And I think that this is what's kind of still being hammered out. We don't really know what the package is going to look like. We don't know what it's going to be passed. But so far, what it appears to be is a very different kind of package with respect to the corporate profits implications than was the 2017 package. In that, in 2017, we got lovely reduction in corporate tax rates. We got all these incentives to invest.
Is that not in there?
This time around, it's just a continuation of what we had.
Okay.
It's not anything new, really, for corporates, except for on the margin. Maybe some incentives for small business owners. Proprietors' income could be taxed at lower rates, for example. Households might get some sweeteners. But corporates net aren't getting what they got last time. So you've got to balance that when you think about the equity market.
Gina, does it offset the increased costs that American consumers could feel as a result of tariffs?
Difficult to say because we don't know where tariffs are going.
I thought you were going to say difficult to say because we also don't know.
Yeah, we don't know
where the bill's going to go.
What the bill's going to really look like, but
mostly too much unknown at this
because-
point. Isn't that the idea that the president has essentially said, okay, well, the tariffs, it's going to be a little bumpy, but if I get this bill through, you're going to feel relief.
Yeah, you'll feel relief offset by the tariffs pressure that is going to continue to emerge. But we don't know what tariffs will look like. Remember, we're only on a 90-day pause. We're not permanently at 30-10. 30 China, 10 everybody else, we're on pause. So we don't know where we're going. At the 30-10, it does still look like it's a downdraft on corporate earnings anyway. Will it ultimately pass through to the consumer? It seems to me that corporates are largely taking the brunt of this in margins, at least at 30-10. Maybe to some degree, we see a little bit of pass through to the consumer, which does mean that the tax reform, to the degree that it is an outright reduction in corporate tax rates for households, should be beneficial to the consumer. But at the same time, it probably is not as beneficial to corporates as the tariff is a drag on corporate profits.
Yeah.
So you've got margin pressure on companies as the net emergent theme out of both, the combination of both. Now, I have to caveat everything with, we still don't know.
Right.
We don't know where tariffs are going. We still don't know exactly what the tax reform is going to look like. But that's where we stand today is net, this is a downdraft for profitability of companies, maybe an upturn for households.
And as you said, let's see what we get next from the White House, whether or not we see a pullback or something. And the president, because he does watch the markets. We do know that. Ultimately, we keep hearing that. Gina, thank you so much. Bloomberg Intelligence Chief Equity Strategist Gina Martin-Adams here in our Interactive Broker studio. All right, let's get to retail, because retail earnings have been coming out. We've talked about Target earlier today, and the stock's under pressure, Tim.
Yeah, it is down to 4.8% as we speak, but it was down as much as 7.7% earlier in the day. The company cut its sales forecast. It followed a sharp pullback in spending and a hit from tariffs, boycotts, and consumer confidence.
On it, as she always is, Jen Bartasha. She's Senior Retail Staples and Packaged Food Analyst, Team Leader for BI Consumer Team. She's is having a busy week. She joins us from BI headquarters in Princeton. Jen, always good to check in with you. Walmart last week reported this is a bit different. Is this a Target problem? Is this a sector problem? How are you seeing it?
Yeah, it's an interesting dynamic that's going on right now. This problem is a little bit unique to Target, but it's also relevant for any of the retailers that are in the more discretionary categories. The one thing you can't forget about Walmart is that more than 50% of its revenue comes from groceries and consumables. And so it has the ability to when you're talking about tariffs, you're talking about consumer spending, they have a buffer because of all of that grocery business that they have. When you're talking about Target, they're still much more reliant on discretionary spending. And they've had some missteps along the way. You've mentioned, some of the boycott ideas, with regards to DEI policies. They've had challenges with their merchandising mix. And so some of it is self-inflicted, but some of it is just a reflection of the current environment.
What's the pressure that this puts on Brian Cornell for this turnaround? Because certainly, as you mentioned, some of this is unique to Target, but this is not a problem or a challenge that has been one quarter in the making. I mean, we could have talked to you about Target's challenges at this point. We have been for years.
Yeah, it's a very good point. I think I'm hearing increasingly questions about whether a new management management change is required at Target to really push a new agenda. One of the things that came out of today's call that was a little bit concerning, once again, higher than expected markdowns are needed. They have to right-size their inventory again. This is a repeat type of scenario that Target seems to keep finding itself in.
Why?
And that's just a challenge.
Jen, I remember when Target could do no wrong. And I have to say, when my daughter was younger, we were in there all the time, but they were great about featuring designers and having fashion label. They just seem to be kind of hitting on all cylinders. And so I'm just kind of wondering, what is it? What do they need?
I think they need to get back to where they become a leader in what's fresh and interesting and new. And for a long time, what was a differentiator for Target was that they had that differentiation in quality in their private label brands. They were fashion forward. But in the last couple of years, you've seen Walmart, you've seen Kohl's, you've seen Dick's, all invest in private label, in improving the quality, improving the breadth of their assortment, and becoming a little bit more fashion and function forward. Those are all areas that were Target's domain. And so it's a lot easier to lose a customer than to win them back. And so I think that's what Target's finding now, is that some of their competitors that were at a disadvantage before are now on more of an equal footing, and customers are okay with that. And so it's going to be a little bit of a long haul for Target to win some of those customers back.
Well, let's talk specifically about the boycotts and the stuff that was mentioned about the backlash of DEI initiatives that the company has taken. Is it because Target for years was seen as a company that did embrace, at least in its marketing, at least in the way it sold, at least in the businesses that it supported and featured on its shelves, was a company that was fully backing the idea of diversity, equity, and inclusion. Then it moved away from this with the recent pressures, and customers are rebelling now?
Yeah, I mean, the Target brand, I mean, for over a decade has been about inclusivity. They were one of the first retailers that really embraced size inclusivity. I remember them showing, special products for people who had handicaps. Like, it's been part of their DNA for a very long time, and it's part of what people appreciated about the company. And so, although policies change and things change, I think the way Target went about it kind of alienated some of their customers. And people didn't understand why there wouldn't be as much support for perhaps a women-led business or for a Black-led business. And so that's part of what's caused a little bit of that friction with what their core brand has always been about.
All right, so 30 seconds. We're in the midst of retail earnings, lots of things. What's next on your radar?
Well, tomorrow we have Costco and we have BJ's, and the warehouse clubs are, by all accounts, doing really well. So it'll be interesting to see if they continue that momentum tomorrow.
All right. Love it, as always. Just looking at Costco, that stock's down just about 1% here ahead of its earnings. Stock, though, up about 12% year to date. Jen, thank you. As we mentioned, though, Target continues to be under pressure. Our own Jen Bartashis, she is, of course, team leader for the BI Consumer Team, senior retail staples and packaged food analyst. You want to know retail? You go to Jen.
Also, check out her research and the entire team's research on the Bloomberg terminal. BI Go to get to Bloomberg Intelligence.
I wonder what it's like investing, VC investing in an environment like that. Turns out we've got a great guest who's dealing with just that. That's next on Bloomberg Business Week Daily.
It's 3:21 on Wall Street. We do check markets all day long here at Bloomberg. 39 minutes to go ahead of the closing bell. Stocks are sliding. We have got the Dow, the S&P, NASDAQ all moving lower. And in fact, right now we are looking at the lows of the day with the Dow down 846 points. That is a drop right now of 2%, just about 2% here. S&P 500 index down 103, a decline of 1.7%. NASDAQ now down 325, a drop there of 1.7%. And the 10-year, 4.58%. The 2-year, 3.99%. The 30-year, 5.08%. Gold up $32 the ounce, higher by 1%, $33.22. West Texas Intermediate crude down 1%, $61.42 a barrel on WTI. And Bitcoin was at a record today right now at 106,860. And this Bloomberg Business Flash is brought to you by ShipStation. Calm the chaos with the shipping software that delivers. Use code Bloomberg for a free trial at ShipStation.com. That's ShipStation.com with the code Bloomberg. So the Dow, the S&P, NASDAQ all declining today. Earnings after the bell coming up will include software companies Snowflake and Zoom Communications. Right now we have got Zoom ahead of earnings down 1.4%. Snowflake ahead of earnings down by 1.6%. But big numbers to the downside, a drop now of 1.7% on the S&P, the 10-year 4.58%, the 2-year 3.99%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie. Do appreciate it. Well, we last checked in with Jenny Rook in February of this year. It was take your time machine, okay? This was in the midst of a lot of the news about federal money being pulled from universities, a pullback in spending that traditionally goes to research. And what we've heard since then, and what I've noticed since then, reading books, reading articles, reading about innovations, is a lot of what I've read about is this whatever, X, can trace its roots back to public funding.
Yeah, it's really important, right? The early development starting in so many federally funded projects. Let's get into it because we know she's got some thoughts on this. We've talked about this. Jenny, of course, Jenny Rook, founder and managing director of Genoa Ventures. It's a VC firm that invests in, as she says, the quote, next generation of companies at the convergence of technology and biology. So much going on when you think about that and layer in AI. She joins us here in our Bloomberg Interactive Broker studio. It is good to have you back with us. What's amazing is somebody said to me, what is it, February, March, April? Got to use my fingers.
A lifetime.
3 months, but a lot has happened.
So much.
It's crazy.
From the administration. And especially things that when we think about funding that goes to universities, different projects, NIH, like I'm just thinking about it, where so much can come out of it that we take for granted today, but also creates companies, adds to the economy. Tell us how you are kind of taking all of this in and then your world in terms of investing in it.
No, you're quite right. Thanks for having me back. It's such an important topic. And it does sound like you've been looking into it since I was here last. And finding just how much of what gets to market started as basic research, funded by the federal government, sometimes decades before it became something that we can benefit from as consumers, as patients, as just regular citizens. So as I've been talking to, we talked last time about large, well-funded universities. Are they really going to be hit by this? And certainly the numbers are quite large for those. But what's important to know is that these kinds of discoveries can come from anywhere. Right? They're often a passionate researcher in a university that might be in a college town, that might be the only industry in that town. And so not only the funding that drives their particular projects, looking into, for example, the mechanisms of a cancer gene, but also the dollars that then go through the indirect funding to that university or college so that it gets to keep running as a business and keep supporting its local ecosystem. So I'm seeing kind of up and down the chain, regardless of whether you're Stanford or a college you haven't heard of, it's really resetting how people are thinking about what they can get done in their labs and in their institutions.
I know I've talked about this book quite a bit over the last couple of weeks, Carol, but we're hoping to get the authors on the program, Abundance, Derek Thompson and Ezra Klein. And one thing that I learned in that book was that the inventors of the mRNA vaccine, who won the Nobel Prize in 2023 for mRNA, their work in mRNA, they essentially toiled in obscurity for decades.
Yes,
and,
that's right.
And that story is more the norm.
That's right.
Than it is the outlier, it seems. And that was something that kind of blew my mind, because you have this research being done and it doesn't seem like it's going to amount to anything until it does.
That's right.
That's kind of the world that you live in.
That's kind of the vibe. Yeah, it's the way we call it discovery. Development is another thing. When now you have something, it kind of works, you want to turn it into a product. That's a great place for venture capital to step in. We love to engage early with those companies. But the discovery portion, you often don't know what you're looking for. You're just curious, right? You're picking things apart. You're turning over rocks.
So how patient are your investors when it comes to this stuff? Because you're not, investing in an app that has high margins and is going to, be a game. If we're thinking about this, like, in the last 15 years of venture capital and what the winners have been, you're not investing in a social media company that has to go viral and become a top app in the App Store, for example.
Well, certainly the journey for a bio or science-based company, a deep tech company, being venture-backed and then becoming a great exit for LPs, those are very different. And the kind of capital you need and whether regulatory matters, which is another thing we can talk about.
Right.
Those are pretty different versus an app, as you say. But the rules of venture capital are still the same. In 7 to 10 years, you need to give your LPs back 3x net. Now, very few VCs manage to do that, but you can still find winning playbooks in the sciences that work for that journey, and that's what we're trying to do, and other life sciences VCs do.
Hey, one thing I want to ask you. So, I just want to rehash for everyone who's listening at this point, because we are seeing markets pretty much hover near their lows of the session. So we're still down about almost 1.8% on the S&P 500, down about 105 points, down 2% on the Dow Jones Industrial Average. NASDAQ 100 down about 1.6%, down 343 points. This, as we've said, really the focus is on the Treasury trade, as we've seen yields move up, a 10-year note with a yield of 4.58, so just shy of 4.6, although we hit that earlier. But really at the longer end of the yield curve, we've seen also yields move up. When we think about the volatility within the market environment, for you as an investor, are you going to be more cautious in an environment like this? Or are you able to maybe make a bigger investment in something because there is stress out there? I'm just curious how that plays into your world.
Yeah, I think most early stage VCs, ourselves included, are already taking a lot of risk, and that is our job, right? To take well-characterized risk that in the long term can deliver outsized returns. And so temporary volatility doesn't change our day-to-day strategy typically. What it does change is the availability of capital to deploy against that strategy. So investors, LPs who are thinking about all of their asset classes, who are dealing with so much volatility and uncertainty, it can be very challenging to have the long-term discipline to say, now is a great time to put money in a 10-year illiquid asset with the hopes of upside. Even if they have that discipline, it can be hard to even just create the bandwidth to find great venture opportunities. So it's a tough time to do the next venture thing, I would say.
It makes it tough. Jenny Rook, we're talking with. She is the founder and managing director of Genoa Ventures, a VC firm that invests in, as we talked about, a lot of life sciences companies, looking at that cross-section between technology and biology. We talked about the volatility in the markets and how it's impacting perhaps you, Jenny. There's a headline that crossed coming from the Wall Street Journal that RFK Jr., of course, key in terms of health and human services for the government, chief advisor to the president, expected to criticize vaccines. We saw some movement this week in terms of vaccines that was seen by vaccine makers, Moderna and others, that maybe it wasn't as bad as everybody thought it might be in terms of approving vaccines for some folks. I'm just curious how policy out of Washington, regulatory environment and so on also factors into how you are investing, where you are investing.
This is a really important question because regulatory, of course, is critical to making sure that safe, effective medicines, interventions, foods are regulated, get to the public in a timely manner. Right. And so venture capitalists often, surprisingly, actually embrace regulatory because it's a way to make sure that something gets to market in a way that will be accepted and effective with patients, for example. And so what's important is to have kind of clear rules of the game. What is required to show safety and efficacy? On what timeline will a regulatory body review those data. That's what's so important. And that's where we're really seeing a challenging set of headwinds as venture investors, where we're often funding a company, just enough, or maybe just slightly less than enough to get to the next milestones, which may be regulatory approval. And if that's going to take an extra 6 months, that can kill a company. They don't have the funds to get through that.
What, in your view, is the long-term implication of this FDA, this HHS, under Secretary Kennedy?
Well, if I knew, that would be a different
You are a venture capitalist, so you are supposed to know the future.
Yeah, we're supposed to take important risky bets. So I don't know, again, what the journey will be, but perhaps one of the upsides to taking these very long-term bets is when I think about a company we might invest in today.
Okay.
Do I believe we will have a functioning FDA that is science-driven and looks at novel medicines and tries to get them to the public in 7 to 10 years? I do. We will still have that, right? Will the timelines be different? Will the requirements be different? Could be. But one of the things I love about science is that it invites inquiry. It invites being tested. It invites discussion amongst people who are trying to work for the same outcomes. So I'm a long-term optimist, let's say.
Hey, Jenny, one last question, because one thing that has become a narrative and a trend is investors looking outside the United States for opportunities. Is that something you are increasingly doing as well?
This is real. We always look at Genoa, we look globally for the very best opportunities, as you were describing, at this unusual convergence of bio and tech. And we look broadly outside of healthcare, food, industrials. But what I am seeing, I just came back from a meeting in Paris focused on industrial bio, which is making industrials like chemicals through bio routes. What I'm seeing is a couple of things. The mood there is lighter than here, for one thing. They're not wrapped up in our drama. And
Sure, it's not the wine and the good food, because everything.
And the cheese. They put out a great cheese plate at break as well. But there is less willingness to deploy their capital in U.S. companies, which had been in the startup space the darlings of the venture capital community. So we're seeing capital shift, and this is true, as you well know, in the public markets as well, up and down, whether it's a startup or a publicly traded leader to Europe.
People have been said, it's a rebalance. Everybody was too overexposed to the U.S. Do you think it's a rebalance, or they're saying, I'm not so sure I like the U.S. environment? Just got about 30 seconds.
I think it's the latter, and I think it's going to make, it's a great opportunity for European investors and European companies to attract some U.S. capital that perhaps wouldn't have looked outside.
Great perspective. So glad you stopped by again.
Yeah, thanks for having me.
Always good to have you here. Jenny Rook, founder and managing director at Genoa Ventures, joining us here in our Bloomberg Interactive Brokers studio. Quick check on the markets.
Yeah, down 1.6% on the S&P 500, 1.9% on the Dow Jones Industrial Average. The NASDAQ down by 1.5%. Taking a deeper look in the S&P 500, everything, Carol, is in the red except for communication services. That's up 0.7%.
Yeah, something like real estate down about 2.5%, the worst performing major industry group in the S&P. I'm looking at a 10-year note with a yield of 4.58, 2-year note with a yield of 4%, folks. This is Bloomberg.
It's 3:40 on Wall Street. We do check markets all day long here at Bloomberg. We are seeing a very slight bounce off the bottom. Emphasis on very slight. We've got the Dow, the S&P, NASDAQ deeply in the red. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. That's right. U.S. stocks are under pressure after that disappointing bond auction. The Dow is currently down 764 points. S&P's dropped 1.5%, while NASDAQ is off by 1.3%. The U.S. 10-year yield jumped to 4.58. Gold is up 1%. Oil is in the red. And the VIX, that's higher by 15%. Among the main 11 S&P sectors, only telecom was in the green. Real estate and healthcare were under pressure. And leaders to the upside in the Dow, only Coca-Cola was in the green, while UNH fell 5.5% and led to the downside. After earnings, Target fell 5%. And in deal news, OpenAI to acquire Johnny Ive's AI startup in a $6.5 billion deal. Wrapping things up, Snowflake reports after the bell. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney. And again, a reminder, keep it locked in to Bloomberg Radio right through the closing bell. And of course, we'll keep you updated on Asian markets this evening to find out how markets continue to react. And to hear live breaking news over your Bloomberg, type SQUAWK, SQUA, on your Bloomberg terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the drive to the close.
The funky music will drive us till the dawn.
On Bloomberg Radio.
All right, TikTok, everybody. Just about 18 minutes to go until we wrap up the trade on this Wednesday. Very different tone from kind of how we kicked off the day. Having said that, you just heard from Bill Maloney and Charlie Pellet. Just to remind you of where we are with less than 20 minutes to go. We're still down about 87 points on the S&P 500, a decline of nearly 1.5%. We're just coming off our lows, but we are certainly well off our best levels of the day. The Dow Jones Industrial Average, a decline of 757 points, down also nearly 1.8%, so some pressure there. NASDAQ 100 down about 1.2%, down 251 points. Again, all of these major equity averages off their best levels of the day, and they are near their lows. You look at the S&P 500. Tim, you've got about 486 names to the downside.
It's not pretty.
No, only 18 gaining ground, so you are looking at some broad-based selling. And we should point out the reason is the worries that we are seeing play out once again along the Treasury market, the Treasury curve. We had an auction that didn't go so well. Demand was weak there. And so you are looking at really the longer end of the yield curve bopping up in a big way. We hit about 4.6% on that 10-year note. Got a 2-year note that has been trading around 4% as well. And so there are concerns, again, about this massive spending package that's making its way through Congress, has some ways to go, but it also will add to the deficit. And so deficit hawks are not happy about it. Investors on Wall Street aren't happy about it as well. They're concerned.
Yeah, also checking out what's happening as you peel back the layers of the S&P 500. You actually see Apple as the biggest drag on the S&P 500 right now, followed by NVIDIA down 1.8%, Microsoft, Amazon, Tesla, United Health Group, among the biggest decliners as well. I want to bring in Sandy Villery, portfolio manager for Villery & Co., joining us from New Orleans. This is a 4-generation family-run firm, Carol. We speak with Sandy all the time. Sandy, good to have you with us. How are you?
Good. Thanks, Tim. Thanks, Carol. Good to hear from you.
Yeah, good to have you join us today. I just want to get your thoughts on how you're looking at what's happening in Washington, because that's really what we're seeing with the market reaction today, at least with that bond auction that then sent equities tumbling today. What's your view there?
Yeah, I mean, we're very stock focused, but I will say it's impossible not to pay attention to it, because just you look at what happened in 2025 so far, all about the tariffs. Now we've got the new bill that's going to certainly increase deficits a little bit. And to your point, we had auction, the 20-year auction was certainly weaker, and now we're seeing yields back to where we started the year, around a 460. So it's hard to avoid a lot of what's going on, and trying to focus on individual names.
Yeah, exactly. And you've got your Villeray Equity Fund. I'm looking at it up about 1.6% on the year. If I look at your balanced fund, it is up about 3.4% year to date. How much movement have you guys been making in and out at this point?
Yeah, but we started the year very defensive after a really good 23 and 24, especially for the S&P that's so tech heavy. So we were more defensively positioned. We had some cash. And then when we got into the lows, those early April lows, we started to buy, and we got about 20% through what we wanted to before the market just V-shaped and went right back up. So now we're back to where we started the year, and we're getting more defensive again. And I think if I look at the S&P and how it may end the year, I see about 5,500 or so on the S&P, and I think it's going to be carried down by a lot of the larger cap tech names. So I think defense is going to win championships in the rest of 2025.
All right, so let's talk about kind of where you are committing money. And I'm assuming these picks are something that have been recent buys, but you can correct me if I'm wrong or right on that. Republic Services, we're talking about a $78 billion market cap company. We're talking about waste management. Stock has had quite a run this year, 26%. Recent buy, adding to it, lay it out for us.
Yeah, I would still buy it. This is an incredible business. It just as long as people continue to get their garbage collected, we feel good about it. It's a mid-single digit free cash flow compounder. They just had a great quarter, and they're getting more into recycling. They've got 2 polymer centers, so fundamentally they're doing everything right, and it's where I want to be, which is larger cap defensive. So I think it's gonna do well throughout the duration of 2025.
Another name that you like on holding, I own their footwear, their sneakers.
Full disclosure.
Full disclosure.
Yeah. She's not wearing them right now.
I've talked with their, CFO. So like we've had them on, we've talked with them. This stock has been on a tear. You're talking about up about 57% in 2023, up about 103% in 2024. This year it's up just shy of 9% here. Again, how long have you owned it? Have you been adding to the position? What are you doing on this one?
Yeah, we bought it, frankly, not much longer after the IPO, which is all the way back in 2021. So we've had it for some time, and that's kind of our style, is to buy and hold, over time. We did add to it not too long ago, and we still think it's going to do well. Now, if you do have a choppy market and things are weaker, this is a great name to add on any weakness. They're just getting started still, in my opinion. Probably grow earnings at 25% over the next 3 years. And they're starting to get into apparel. They're getting more stores out there, probably closer to 100. And if you're worried about supply chains, they get about 80% through Vietnam as opposed to China. So I just feel like it's still going to be moving in the right direction. And if you get some weakness, you get an opportunity to add to it, and I would.
Did you buy in early April after it was hit?
This wasn't one that we bought in April, unfortunately, but
it's up about 60% since there. I didn't either, so I'm with you. But
yeah.
Okay, you didn't.
Yeah, we did. We bought 2 other names, but what an opportunity! And anytime you can buy a great company like this that is still just running on all cylinders, and in our opinion, is you buy it on weakness. We had other names we wanted to add at the time.
What you said you added 2 other names off of the April sell-off. What were they? I'm just curious.
It's interesting. One is a company called Pinnacle Financial that is a bank in Nashville that we really like, and our intention was to take a larger position. We just never got the opportunity to do so. Unfortunately, just because of the V shape. All of a sudden it was just got to a multiple that was a little bit too high. And we added to a little bit of Stryker, just knee replacement, hip replacement, probably on the safer side of what was going on at the time. So like both names, but unfortunately didn't get a chance to fill at least the Pinnacle.
Oh, okay. So in other words, you did buy Stryker at the low, but Pinnacle, you saw it, wish you had, but hadn't bought it. You didn't buy it at the low.
So not to get into too much, but we bought about 20% of our position, and then by the time it V-shaped, we were sort of boxed out from finishing it.
Okay.
So we actually kind of sold what we had, and we look to add it if we do get more choppiness in the next month or 2.
Pool Corporation, I pulled up the DES page on the Bloomberg terminal. It's down a little more than 10% this year. I actually was expecting it to be lower because I recall late last month, the company reported earnings that they essentially said fiscal year earnings per share will come in just about what analysts saw, but they did report first quarter earnings per share that came in shy of estimates, and first quarter net sales that came in shy of estimates. This one was surprising for me to see on your list of stocks that you're bullish on, because isn't the concern the company essentially said the environment was weighing on new pools? So not necessarily a name that you would want to own in an environment where consumers aren't spending money, no?
Yeah, so what happened in 2023, there were about 70 to 75,000 new pools built, and now we're down to about 62,000 as you closed out 2024. So about 15% of their business is new pool construction. It does carry higher margins, and it's a great part of their business. But 2/3 of their business is just repair and maintenance of your swimming pool. So this is a true, long-term hold where, as long as people are putting chemicals and chlorine into their swimming pools, they're remodeling, and basically every 10 to 12 years, you might have to replaster. These guys are as big as their top 10 competitors combined. And so when you get weakness in one little part of their business, new pool construction, which is important, and that kind of pushes the stock down to a reasonable valuation to us, it's a great opportunity to add. If you get any strength in new pool construction, and look, today's interest rates aren't helping, right? People aren't going out and trying to borrow money to put in a new pool. But in general, you get any sort of strength out of already, diminished expectations from analysts already that have taken their numbers down. I think it's got, could be a $350 stock, in my opinion.
Hey, one thing I'm curious, Sandy, at this point, are you higher in terms of your cash allocations in your funds right now, kind of keeping some powder dry, lack of a better expression, but often used, right, in environments where we're not quite sure what's happening next? Are you keeping more money handy and ready to put to work than you normally do?
Yeah, we do have higher cash levels, and we sort of came into 2025 like that, and then we tried to invest what we could. We just didn't have a long enough. We didn't think the whole market malaise would be 3 days, and so we didn't have enough time to put it to work. But now we did raise a little bit more cash, and so we are cash heavier than we have been. And it wasn't necessarily that we were worried about valuation or things like that. We couldn't find new stocks to buy that really met our investment criteria of being cheap. So we go to the sidelines. We will get a little bit over 4% in money market and just wait for those opportunities. And ideally, we see them maybe over a week or summer.
I've heard Warren Buffett say the same thing.
Yeah, no, that's right. And it's funny talking about pool. Berkshire Hathaway did just increase their position middle of May by about 900,000 shares. So they've become a top 5 shareholder. So good company with those guys. But yeah, no,
what are your people really try to parse through every single thing Warren Buffett has to say at annual meetings, and whenever he opens his mouth to try to figure out what exactly he's going to buy next. What are your, as a value investor, what are your parameters in an environment such as this to say, okay, I'm ready to get off the sidelines and buy this individual company?
Yeah, and that's where we were in that those April lows. We've got a laundry list of 10 names that really meet our criteria, which are just having a company that just absolutely dominates their niche, and Pool certainly fits that build. onsemi, Republic being the number 2 player behind Waste Management, but a really dominant franchise. That's what we're looking for. And many times you have to pay up for those types of businesses. But if you get market uncertainty and things that are going wrong from a macro or a DC standpoint, and you can get into one of those businesses, that's what we always look for.
We've gotten that, Sandy.
Yeah,
market uncertainty, right. Questions about the outlook. I am curious, in a day where we're all, seeing nervousness, risk off, come back into the equity trade and seeing those yields move up again. An argument that, go back 10, 20 years, we had concerns about the U.S. federal deficit. So I am curious how that factors into, I understand you're a stock picker, you're looking for valuations. Are you anticipating an environment where stocks are going to get beaten down even more? Maybe we even go into recession, and that's an opportunity for you? Or are you a little bit more worried that it's something more problematic? Or you're saying, you know what, this will turn around?
Yeah, I do think as yields pick up, I mean, if yields keep climbing, and I do think that's at the end of the day going to dampen equity returns as those go a little bit higher. I think there's when you look at tariffs and everything else that are going on, I think that causes boards of directors of publicly traded companies to sort of pause on some of the things they may have been doing. And I'm not calling for a recession, but I am calling for a little bit of a slowdown. And I think there's going to be better opportunities as we get further into the year than maybe we have right now. I mean, it's pretty amazing that the S&P was down almost 18%, and now we're back to break even. I'm sort of looking, towards the end of the year where I think that if you looked at a Vanguard value index, I think it could outperform, say, Vanguard growth. And if you look over the last decade, growth has outperformed value by about 7% annualized. So I'm also looking for some reversion to the mean. So in general, I'm trying to find those cheaper dominant companies in the market and trying to avoid some of the larger cap, expensive, Mag 7 names.
What portion of your assets under management right now do you have in cash?
I'd say in general, we're probably like 14 or 15%.
And what do you typically
higher than we normally are?
So what's your normal?
We're probably closer to 4 or 5%.
Okay. What do you anticipate going? Look, you can't see the future. None of us can. But just in terms of the way you're thinking about this market environment, do you anticipate getting to that 4 or 5% level this year? Or are you willing to stay on the sidelines until next year?
No, we do not like to be this cash heavy. And again, it's not that it's more of a buyer strike, right? We just can't find those companies that are cheap because they've just rallied on this V-shaped recovery that we've just had. So I hope to be 97% invested. As we get through the year, we just need to find those names and put that cash to work. So a bit of an anomaly to be this cash heavy, frankly.
Sandy, really quickly, 30 seconds. Anywhere along the U.S. Treasury curve that you find attractive, or are you just staying away at this point? I know you're in corporates and other things, but I'm just curious when it comes to U.S. Treasuries.
Yeah, I would say if maybe they rallied a little bit further, maybe we'd get more interested in picking up some. We do have about 25% of our balance fund in corporate bonds. We like to buy triple B, single A.
But I mean in terms of Treasuries, anything in terms of U.S. sovereign, or are you just staying away?
No, we're staying away. In our opinion, just looking at corporates versus treasuries, we think you get paid a lot more in corporates versus what tends to be risk-free. And so we'd like to pick up a little bit more yield by doing a little bit of research and buying some, maybe some, on the lower end of investment grade, corporate debt.
This is exactly what Michael McKenzie told us earlier in our program.
Yeah,
why buy treasuries when you can go and buy from companies?
Totally. Like it makes sense, right? Hey, Sandy, be well. Sandy Villery, portfolio manager for Villery & Company, joining us from New Orleans. All right, folks, we are counting you down to the close. Just a few minutes to go, about 2.5 minutes until we wrap up the trade on this very interesting Wednesday. Heading over to our TV colleagues. That's because the closing bell starts right now.
B500, a full breakdown of all of today's market action starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Alex Steele taking you through to that closing bell. It's a global simulcast, and it starts right now. Scarlett Fu in the TV studio, Carol Masser and Tim Stenevec in the radio booth. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube on a decidedly down day for the market. Carol Masser, only 18 stocks in the S&P 500 in the green.
Yeah.
Can you name them all?
No, but...
that was quick. You didn't even try, Carol.
Well, I wanted to kind of get to, we just had a conversation with Sandy Villery over at Villery & Company, right? And they've got a couple of funds out there. He's talked to us about having about 14% of their portfolio in cash right now. Typically, it's 4 to 5%, just kind of holding back to wait for things to calm down, and look for better opportunities. He's a value guy, but it's just a much more negative risk-off tone.
Yeah, I mean, look, if we think about the crucial moments of the day, the soft 20-year auction that led yields to spike earlier in the session and led stocks down, that was the issue. Concern of what's happening in Washington when it comes to the spending bill, when it comes to adding to the deficit, certainly top of mind. To continue on what Carol was saying, Sandy Villery essentially saying he's staying away from treasuries. He's like, I would rather buy, if I'm buying fixed income, I'd rather buy from a company that I know that can pay me back.
Well, that makes sense.
Yeah, a lot of people have said corporate credit, at least by the big blue chip companies, is a safer bet, a safer haven than treasuries. I loved what Peter Bookvar said about how, like, he never writes about the 20-year auction, and surprisingly, this is a one day that you write about this kind of orphan child of the treasury market.
I don't think anybody writes off the 20-year auction.
Well, we are talking about it today.
Ira Jersey writes about the 20-year auction.
Okay, there you go.
20 years, so hot right now. All right, and the market not necessarily so hot as we get the closing bells here in New York. A really serious situation here as yields really did drive the story, pushing the markets down to one of the worst days in the last few weeks. The Dow Jones Industrial Average down about 1.9%, more than 800 points below that 42,000 level. The S&P 500 dropping about 1.6%, about 95 points lower on the day. And we should point out, about 485 stocks in that index are moving to the downside. The NASDAQ down 270 points at 1.4%. And the big decliners on the day, you're going to find that with the Russell 2000 down 2.8% and Dow Transports down 2.7%.
All right, you did the industry groups. You said, oh, you didn't do the industry groups, but you said
not.
most of the names in the S&P 500. Wait. Most of the S&P 500 names are lower in today's session. The worst performer, Fair Isaac, which also had a tough day yesterday, right? It's down another 16% in today's session. Best performing name, it's going to be one of my gainers, guys. It's Alphabet. But
deep tease.
Take it away, Scarlett.
All right, let's take a look at the IMAP. A lot of red there. You mentioned Alphabet, Carol, and Alphabet, as well as Netflix, but just barely, are basically supporting the communications services sector, and you can see that's the one lone slice of the pie that is green. That group is up about 2/3 of 1%. You have three sectors down at least 2%. Two of them are rate sensitive, REITs and financials, and healthcare losing 2.4% because of United Health.
All right, guys. There were a few gainers, as Scarlett just mentioned. Alphabet, certainly among them, up as much as 5.5% at its highs, finishing the day with a 2.8% gain. It was pretty much your biggest gainer in the S&P 500, NASDAQ 100. What happened is the company said it will offer AI mode in search to all U.S. users. So kind of AI mode.
Like turbo mode.
Like, exactly.
You got to pay for it, but okay.
Is that like hollow mode or what?
Hey, it's showing its commitment to redesigning its core business to keep pace with its new rivals. You know, AI mode, you do anything with AI and everybody gets excited. But right, as Alex said, you're going to have to pay for it. DeFi development, folks, small market cap, 438 million, but it was up 40% here pretty much at its highs, all-time highs, a blockchain developer. And this is after Solana said it instituted a 7-for-1 forward stock split today. So we saw this one also benefiting in the trade. And here's another one. I don't really talk about it a lot. DY is the ticker. Dycom Industries, $6.5 billion market cap. Builds fiber optic systems for cable TV operators, boosted its year forecast for contract revenue growth. And so this one definitely an outperformer, and the stock's up about 30%. There's a few other honorable mentions like Canada Goose and CoreWeave, but you'll just have to go to the Bloomberg to check that out.
Ooh, okay. Nice tease.
Yeah.
Hey, easy job for me today with the decliners. I do want to start with shares of Apple falling 2.3%. It was the biggest decliner on a points basis in the S&P 500. Shares fell right when we learned about OpenAI acquiring the AI device startup co-founded by Apple veteran Johnny Ive in this nearly $6.5 billion all-stock deal. But that was also the time that we got that soft 20-year auction that led yields to spike. So worth noting, not necessarily those two things correlated, but you can't talk about Johnny Ive without talking about his history at Apple and the way that Apple has missed out on the AI boom over the last couple of years. Check out Mark Gurman's reporting for that. Also, shares of Target down by 5.2% today. Shares fell close to 8% at one point in the day. The company cut its sales forecast following a sharp pullback in consumer spending and a hit from tariffs and boycotts. A little different than what we saw from Walmart last week for a couple reasons. One of them has to do with the fact that Target sells more discretionary items to consumers rather than groceries, whereas Walmart has about 50% of its sales as groceries. So those are not discretionary items. Consumers have to buy those things, so it buffers in an environment such as this. Target said Wednesday it expects net sales to decline by a low single digit this year, down from previous guidance for an increase of about 1%. Questions also being raised about Brian Cornell's tenure at the company and the turnaround.
Here? Yeah,
what's that?
What's going on with Brian Cornell?
Well, look, in 2022, they said he'd be there for at least 3 more years.
Yeah.
And he's had many years. He's been there since 2014. Mm-hmm. He's a veteran of Walmart. He was the head of Sam's Club at Walmart. Yeah. He's at Pepsi also.
Got a great pedigree.
He did.
And have you looked at the relative performance?
Don't you feel like we've been having this story, this conversation about Target's turnaround for years at this point?
Yes, I do. 100%.
Like they had inventory issues and COVID, then it was the DEI issues. Like there's been issue after issue that's target specific in many ways, and then not the macro, which is also a problem.
I just want to put this into perspective. Over the last 12 months, shares are down 40%. Walmart shares are up 48%. You pick any of sort of the other competitors, whether it's the dollar stores, BJ's, Costco, you also see similar extreme underperformance relative to some of those.
You can't say it's all because of discretionaries and not having growth.
I don't think it's cool anymore. I used to love when it used to do the designer collaborations, and it was kind of fun, and they would have people line up for hours. They just, I don't know. I go in there and I feel like it's the same old stuff.
Yeah, and just maybe a little bit more expensive.
I
was just going to say that. A teeny bit more expensive.
You never leave Target without at least spending $100, $150.
True.
All right. You want to hit yields, Alex?
Oh, I do, yes.
Yeah.
Yields, they moved higher. It was the big story of the day, that 20-year failed auction. They were already trading heavy on the back end before the auction, but after that auction, you definitely saw a spike higher. The 30-year yield, now at the highest level since October of 2023, did not see buyers come in once the 30-year breached the 5%.
All right, well, speaking of a spike higher, shares of Snowflake, the enterprise software company that's been trying to turn itself into an AI company, up 3% in the after-hours trade after just reporting earnings. First quarter revenue did beat at about $1.04 billion. First quarter adjusted diluted EPS also beat at about 24 cents a share. The company says that for the second quarter, it is expecting revenue in the range, basically of 1.04, so no real range here, but that is above the average of analyst estimates by just a hair. The company also saying that for the full year, it expects its product revenue to be $4.33 billion. That's an upgrade from its previous forecast of $4.28 billion and above street estimates of $4.29. The share is now up 6% in the after-hours trade.
All right, let's look at Urban Outfitters, the specialty apparel company. Net sales for the first quarter beat analyst estimates, and if you look at the two biggest brands, Urban Outfitters itself and Anthropologie, those numbers also coming in better than anticipated. Segment sales, so comparable sales, up 2.1% when analysts were looking for a drop. No indication yet of the outlook, so that'll be perhaps in the earnings call with any kind of commentary about tariffs and all of that.
All right, one more before we bail out here. You got Zoom Communications. It's bouncing around in the aftermarket, up about 1.5% here. This is after the company came out and boosted its revenue guidance for the full year, the guidance beating the average analyst estimate. And it also sees adjusted EPS 556 to 559, had seen 534 to 537, estimates 536. So that's bouncing around, up about 2%.
And just real quickly before you go, Carol, Lumen shares right now spiking more than 20% here. The main headline, AT&T is going to buy Lumen's mass markets fiber business. We'll get you some more details on that, but those shares up more than 20%.
Yep, we're definitely seeing some movement there. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals.
Thanks for keeping it clean today, by the way, Carol.
You're so funny. All right, Alex is heading out. Scarlett and Romaine continuing over there on TV. Tim and I are going to keep it clean as we continue on Bloomberg Business Week Daily. We'll see you again, same time, same place tomorrow.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
It is Bloomberg Business Week Daily. That is Carol Masser. I'm Tim Stenivek. Just a reminder of where we closed on the day today. Down 1.6% on the S&P 500, the NASDAQ down 1.4%, the Dow down 1.9% today. We did see some selling later in the session after about 1 p.m. That's when we got that soft 20-year auction. We saw yields spike, especially at the long end of the curve. Concerns that investors have about what's happening in Washington, the fiscal situation, what's happening with the big, beautiful bill, as the president calls it.
You know what you do when you're nervous? You know where you run?
Oh, I know what you're going to say.
You run to Bitcoin.
Okay, that's exactly where I wanted to go, because not everything was kind of nuts today.
It's the safe haven.
Well, I guess it kind of is now.
Is it really?
Bitcoin did hit an all-time high after the advancement of stablecoin legislation in the U.S., as it stoked hopes of regulatory clarity under President Trump. Taking a look at CRYP Go on the Bloomberg terminal, Bitcoin's up $100 to $108,600 as we speak. We've got Mike McGlone in the house. He's senior commodity strategist for Bloomberg Intelligence. He's usually hanging out in Miami, but he heard the weather could be good this week, so he came up to New York. He joins us
wrong.
here. I know. It was nice the last couple of days. He joins us here in the Bloomberg Interactive Brokers studio. Welcome back, Mike. How are things in Miami?
Wonderful.
Okay. Are you a crypto bro now?
Actually, I've converted, unfortunately. I'm much more bullish gold starting last year.
Okay.
And so far, it's playing out well this year. The crypto whole space now is just so much of a pile-on trade. There's so much excessive silliness now. And it's the exact opposite when I really was getting bullish crypto, 2018, 19, when everything we have now we look forward to. We look forward to ETFs. We look forward to our government figuring out a way it attracts dollars and invests in treasuries. And things that are happening, just it's in the space. Crypto dollars, major bull market. Now, everybody's grabbing onto it. It really has the sense to me like I remember in the stock market in 1999, and when I started in the business around the late 80s in Japan, it's just massive speculative excesses. So I'll give you one example. Dogecoin, the number 8 cryptocurrency. It was launched as a joke. It has $33 billion of market cap. So we're at the stage now, as long as the stock market goes up, Bitcoin will do well. Now, today was rare.
Quick correction, 34 billion.
There you go.
Isn't it as simple as all roads lead back to the White House? I mean, we are seeing a White House that is super, super friendly. And I don't think I'm speaking out of turn that you have a president or presidential family that is involved pretty heavily.
No, I think that's fair to say, Carol, given that tomorrow night is the dinner for the meme coin holders.
So that it's very clear. And so you do wonder, is this just a 3.5-year thing, or is it something more substantial, especially if you get into the regulatory side of things?
So it is clearly that, but do you want to buy into that where you buy in an asset class where you're completely dependent on the success of the Trump administration? Now, the key thing is they're going to do fine, but if the stock market goes down, everything goes down. So I'll point out a key fact about Bitcoin. It has a very high correlation to the stock market. On a 16-quarter basis, which is like the 4-year cycle, it's 0.7. And gold has a very low correlation to the stock market.
What is it, Ray? What is it on, not on a 16-quarter basis?
Because gold is a real safe haven.
Yes, there you go.
But what is it really this year? Because I think that's where people have latched onto it, especially as it led the rally ahead of stocks and outperformed equities.
I'll give you a good example. When the S&P reached its low this year, it was down 15% or so. That was April 9th.
Yeah.
Bitcoin was down about 20%. Gold was still up about 20%. Now gold's up about 30% on the year. Bitcoin's hanging around 15%. So my point is Bitcoin and cryptos will be fine as long as the stock market goes up. So today was a key inflection point. I look at it as a trader. We've had a major short covering rally in all markets, Bitcoin, stock market. And to me, I look at it as, okay, maybe it's time to retest those shorts that we flushed out and make it prove strength. So I think tomorrow and now that S&P 500, unable to get above 6,000, can go back down to 5,000. And then we have those tilts from people like Gina Martin Adams and Anna Wong. They're pointing out there's a good potential that we're having a recession kick in, the one we didn't get in 2023. So I think we're at very risky levels for Bitcoin, and I see gold as a bull market.
Yeah, continuation, right?
Exactly.
Of such. Okay, so yeah, listen, I don't know. I feel like you're preaching to the choir. I feel like crypto is still something I just don't quite get in terms of what it is.
I think Mike changed his tune a little bit.
Oh, absolutely.
Because you used to say to us, this is digital gold.
Yep.
Yeah.
This is a supply and demand story. This is what gold is, except it is a digital version. I haven't heard you say that today.
Well, so that's one thing I'm really worried about. I remember, having these fears in the past. For periods of time, it's digital gold, and other times it's leverage beta. Right now, it's very clearly leverage beta. If stock market goes up, it leads the way, and it has. If stock market goes down, it leads the way, and it has. So that's my fear now.
But can you be both?
At certain points. So that's why there's times to be overweight gold in an environment, and there's an underweight Bitcoin. It should be in the same space, and there's time to do the opposite. I think right now still a time to be overweight gold. That's working out well this year. Gold's still beating.
No, but my point is, when you've got an asset, right, that can be like a safe haven, and then it's not. You know what I mean? Like, what is it then?
It's leverage beta right now. It's very much not a safe haven.
Right.
And we've proved that this year so far. Like I said, when we were down the lows, Bitcoin was down more than the S&P 500. Gold was up.
Ah, okay. So throwing a little water on this narrative that Bitcoin is a safe haven. Can we talk, are you done with crypto? Because, well, he's here.
Oh, I've been so done with crypto. Only regret is like 10 years ago, right? Throwing a little bit of money.
But that was the time to buy. Now everybody did. Now it's the
get out your time machine.
Exactly.
Let's talk oil. This is like your wheelhouse.
Yes.
And we've been dying to talk about what's been happening with oil. We had a CNN report overnight that raised some concerns about Israel possibly striking in Iran, and this sent oil prices higher today. Taking a look at the big picture, though, the decline in oil prices that we've seen, To you, is that a recessionary signal?
Oh, absolutely. Gold up 30% in the year, crude oil down almost 20%. That very rarely happens. 2008 was the most extreme ever. That's a sign of lack of organic demand for crude oil. Obviously, we have more supply and safe havens going into gold. The key thing to think about crude oil is last year's low was $65 a barrel, and every time we try to pump up near there, it fails. Sellers come in. It's a bear market. I still think it's not going to bottom till around 40. It's not profound to say that because the last 20 years, every low has been around 40.
How much, though? What's the bigger factor, though, on oil? Is it supply or demand? Because, again...
Both.
But what is it even?
The most significant factor in all commodities the last 20 years is the excess increasing supply out of the U.S. and Canada versus demand in liquid fuels and petroleum. Right now, this year, we're on pace to be net exporter of 4 million barrels a day just from the U.S. With Canada, it's approaching 7 million barrels a day. China's demand has peaked around 11 million barrels a day of crude oil, but that's kind of lagging stuff. The point is it's peaking in their demand in China, and then OPEC's back on. So it's a classic bear market in a commodity that's going the way of whale oil.
But are we awash in oil?
Yeah.
Hold on. A commodity that's going the way of whale oil?
Yes.
They've been saying that to me for 20 years. There's a book that came out when I was in college called, I think it was called like Peak Oil or something like that.
Yeah.
It didn't happen.
It didn't, but now it is. But here's an anecdotal point.
Is that Dan Yergin?
Looking it up.
I don't know.
My
Okay,
electric
look
vehicle, plug-in electric vehicle, is 11 years old. The BYDs coming out of China are just phenomenal. And then this drilling technology, it's just a classic bear market. But this was the case. This wasn't the case when it made those lows at 40 the last 3 times. The first one was 2008, but it is now.
So does that say to you that, okay, we know the pushback maybe in this administration or the world, saying ESG and pushing all that, or EVs and so on and so forth. You're saying, nope, that's already left. We're going to go still that way, and it's going to hurt.
We also have a presidential administration very much with the vested interest of lower crude oil, and I think they're going to get it. And lower yields. They're not getting that yet now. But the bottom line for me, crude oil, is this is the trend before Trump was elected. And it's just going that way.
Don't you think, too, in terms of the Middle East, like they get it. They've gotten it for years of saying, listen, we understand this is, making us super, super rich, but this ain't forever.
Yes, and look what happened. OPEC was able to hold off their supply for a couple of years, and now they have no choice. They need the money. Also, what's a vested interest? What really hurts this war factor with Russia's revenue is crushing crude oil. And I wrote about that in 2022 when I first started calling for $40 a barrel, because that's the elasticity kick in. The higher price kicked in that supply and it's cutting demand. And it really helps alleviate some of those issues with the war.
I finally found the book. Sorry.
I knew we lost you for a while.
You lost me because I was trying to. 2005, the book was called Beyond Oil, The View from Hubbard's Peak.
Okay. Who wrote
it? Kenneth S. Duffy's.
Okay. All right. Good to know. Thank you for that Google search.
Yeah, you're welcome. It took a while. It's Amazon
the
involved,
significance of 2005? That's when the demand for crude oil, use of crude oil and liquid fuels in this country peaked. Now that's happening in China.
This was also before hydraulic fracturing.
Yeah, exactly.
So, technology changed.
I remember being up in the Bakken and another boom, and everybody, all the locals were like, we've seen this before. Yep, ride it for now, but it ain't going to last forever. Mike McGlone, nice to have you in studio.
Thanks for having me back.
Thank you. Senior Commodity Strategist at Bloomberg Intelligence in our Interactive Broker studio. All right, folks, if you're just joining us, just a reminder, we saw a little bit of a sell-off, certainly on the equity side of things. Down on the S&P, about 95 points. NASDAQ down about 287. This is Bloomberg.
It's 4:21 on Wall Street. We do check markets all day long here at Bloomberg, and this Bloomberg Business Flash is brought to you by Oracle. Attention growing businesses. Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure for new U.S. customers with minimum financial commitments. See if your company qualifies at oracle.com/Bloomberg. Down day for the Dow, the S&P and NASDAQ, a 1.6% drop in the S&P, down 95. The Dow down 1.9%. NASDAQ down 1.4%. The 10-year 4.59%. The 2-year 4.01%. The 30-year 5.08%. Earnings after the bell. Lockdown darling Zoom Communications higher after earnings. Right now we've got Zoom advancing by just about 2%. Snowflake after earnings up now by roughly 7%. Deal news, AT&T buying the consumer fiber operations of Lumen Technologies for $5.75 billion. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks for that, Charlie. Do appreciate it. I don't know, Carol, if you caught wind of this yesterday.
Well done, well done.
But the Trump administration's
did.
surprise reversal of an order to halt a $5 billion wind energy project off the coast of New York offered some respite to a beleaguered industry whose future in the U.S. has been in doubt. We're talking about shares of Ørsted, based in Denmark, jumping as much as 18%, the most in more than 3 years. Vestas climbed as much as 8% in Copenhagen. Equinor gained up to 2% in Oslo. A reminder, the president, not the biggest fan of wind energy.
We'll have an economy based on wind. I never understood wind. You know, I know windmills very much. I've studied it better than anybody I know.
You see these things all over the place. They destroy everything. They're horrible and the most expensive energy there is. They ruin the environment. They kill the birds. They kill the whales.
You remember when I used to say, darling, I want to watch our president tonight on television. And the husband looks, I'm sorry, dear. The windmills aren't wind. There's no wind tonight. You can't watch, darling.
So we're going to try and have a policy where no windmills are being built.
Okay, the president, his views on wind over the last couple of years or so. Very clear, yes. Back with us, we have Jonathan Maxwell, founder and CEO of SDCL. It's short for Sustainable Development Capital, LLP. Bit over $2 billion in assets under management. Jonathan, also the author of The Edge, How Competition for Resources is Pushing the World, Its Climate to the Brink, and What We Can Do About It. He joins us here in the Bloomberg Interactive Broker Studio. Oftentimes, we're talking to you when you're in London. It's good to have you with us here in the studio.
Thank you.
How do you think about wind as an investment opportunity in your portfolio for the assets that you manage, and as a way that we can wean ourselves away from fossil fuels?
Right. Well, I mean, the wind is a very good contribution, like solar and some of the other sort of bigger renewable energy technologies into the grid system, but it needs balancing, right? Wind produces energy when it's windy, obviously. Solar produces solar at certain times of day. So these technologies need to be integrated into the electrical grid, but integrated with other forms of generation so that the grid can be stable. So we are huge advocates for renewable power, but we're also huge advocates for a stable grid system and also, frankly, an energy system which, or at least solutions to an energy system which recognize that electricity is still a very small proportion of the energy mix in countries like the United States, Europe, UK. Do you know how much electricity is of the energy system?
I have no idea.
About 20%.
So the rest being?
Well, we've got fuel. So
okay.
If you think about all,
you said wind is 20%?
No, electricity in general.
Electricity,
So you know, renewable power technologies like wind and solar increasingly contribute to the amount of electricity that's being generated at any given time on the grid. They need different types of technologies to balance them out so that the system's stable. Nuclear, gas, other forms of what they call baseload generation. But what I'm putting this into context, electricity is still, we're not really in a very heavily electrified economy, not in the United States nor in Europe. In fact, China is more electrified than we are. About 30% of all energy in China is electric. The rest of it is gas. This is in this country, nukes, coal, gas and coal and fuel sources like oil.
Right.
So we are still not very heavily electrified. So wind is a good contribution to still a too small a proportion of the energy system.
Should we be more electrified? Because there was a view here, especially in New York over the last few years, speaking to contractors here in the city, it's really difficult to build homes that even have gas lines coming into them. Yet, when we use these appliances that are powered by electricity instead of gas, oftentimes they're powered by electricity that is produced using fossil fuels.
Right.
That's an issue.
Yeah, so let's just put this into context. Electricity plays a huge role in your and my lives at home. So a big contribution in residential. It's a big contribution in commercial buildings. It's a very small proportion of industrial use. So for example, you've got very high levels of heat, very high temperature process heat that you need in the steel, chemicals, cement, plastics markets. This is not generated by electricity. So yes, the answer to your question is we need to start to generate more electricity, or rather to electrify these industries more. Well, I tell you where there's an area which has got huge electrical demand, which is data centers. So this is...
Listen, you're preaching to the choir.
Right.
Tim has heard me say this a million times, just coming back from Milken, and it's always, we're talking about private credit, and this year we were talking a lot about tariffs, but data centers was one of the things that people said they're still investing, they're still building. And then when you think of data centers, you have to think about the energy usage.
Sure.
It's something Bloomberg has done a lot of reporting on,
and you're going to see electricity use this decade probably double. Now, the issue that you've got, though, putting this all back into context, we've now talked about electricity, we've talked about the energy system.
Right.
The extraordinary thing is that if you look at the efficiency, and by which I mean, if you take the fuel, whether it's electric fueled by wind or solar or nuclear, uranium, gas, coal, whatever fuel source, and you look at the amount of, that's what you call primary energy, the fuel that goes into the energy system, and you compare that to the amount of energy that actually gets to a building like this one, extraordinarily, it's only about a third of the energy that survives that system. Isn't that amazing? So we're wasting most of the energy. So we talk all about, let's do more wind, do more solar, do more nukes, do more whatever we can, do more gas.
But let's make it more efficient.
But most of it's being lost. Let's make it more efficient.
So where do we kind of screw up? I was just thinking about our guests that you always remember, and I'm always like, phew. But we talked about battery. Was it a solid state?
Yeah, solid state battery.
Like what is it that we need to do?
Factorial.
Thank you very much. She was on with us this week, but they've been working on this for a while. Lighter battery, more productive, but they're not quite there yet, maybe in terms of EVs and other usages. But so what do we need? What is it that makes things more productive and that we're not wasting so much?
Well, we need to go to the heart of the problem, right? And the problem is partly it's grid. Grid is often seen as a solution, but centralized energy networks, the reason all of this energy gets lost is that you lose about 10% in extraction, about 50% in generating energy. Why? You put gas or nuclear, uranium that is, into a power plant.
Right.
Half of it goes up as heat into the atmosphere, into space. They don't need it up there. The rest of it turns into electricity. And then another 10% gets lost in transmission and distribution. That is the strategic problem is centralized power plants. Like, in other words, building them out in the middle of nowhere and getting the energy into town. The solution is decentralized. That's the D in my book.
But no offense, I think, did we talk about this last time? Do I really want that nuclear plant right
in your
behind
backyard?
me?
You don't want your own personal small reactor?
No,
small modular reactor?
I'm not so sure I do in SMR. But I do wonder. Like everybody's talking about the importance of localization on a lot of things, supply chains, everything. How do we do that without it not being like a power plant in everybody's backyard?
Well, we've built a portfolio in 10 countries of 50,000 properties connected to energy systems that we've built. Very often you can't see them. They're on the roof, they're in the basement, they're integrated into your building, they're rooftop solar, they're ground and air source heat, they're geothermal, they're waste heat recovery and industrial processes, their natural gas cogeneration.
Right.
A lot of this infrastructure you don't see. You don't know of course you know, but in this building, there is a generator in your basement.
Right.
In Bloomberg in London, the first thing that got built was a generator in the basement.
Is that what it's all about, though, creating a generator everywhere?
It's decentralizing energy generation. So let's say that a lot of what we're doing for data centers are struggling to get onto the grid. Right, the grid availability is very low, the carbon content's high, and the price is high. We build energy generation at the point of use in data centers. We've been doing it for a decade, And by generating the energy where it's needed, not only are we not losing most of it to get there, but we can actually even use any type of energy that we generate, whether it's electricity or heat for cooling.
Right.
And that is a solution to the problem. There isn't a silver bullet. You need the grid. But to decentralize the energy network, everybody's talking about it. Few people are doing it. We've been doing it for 15 years.
You're hearing Jonathan Maxwell right now. We're speaking to him. He's founder and CEO of SDCL, Sustainable Development Capital. It's more than $2 billion in assets under management. His book, The Edge, out now.
So, what's the energy impact? So I'm just thinking if we have multiple smaller systems, I know you talk about waste and we have to take that into account if these are more efficient systems. So what's the net? What's the research? What's the, you know what I mean? Like if everybody has it, is that better for the environment?
Okay, well, let's talk about everybody in America just to start with. So America spends, these are very round numbers, but it spends about $4 trillion on energy a year. According to the Lawrence
You're talking about residential, but everything.
All domestic buildings, about 40%, industry and transport. According to the Lawrence Livermore National Laboratory, which has been running these numbers since the 1970s, America loses about 2/3 of the primary energy in the system. So if you're spending $4 trillion and roughly 2/3 of it's wasted, we're talking about potential savings to the US economy of $2 to $2.5 trillion. So, you know, I'm British. I listen to as much as I can of US media. I have listened very carefully to the Trump administration and the Department for Government Efficiency. Under our feet in America, where we're standing today, are trillions of dollars of savings by decentralizing the energy network. And by the way, this is even before I talk about the amount of energy that is lost in buildings.
So why isn't it being done? Come on, like I always wonder about when something, you've been doing this for a while, it makes sense, it's logical. Why isn't it being done?
So first of all, energy companies are paid to supply generally. So there are now an increasing number of decentralized energy companies, or what I describe as EDGE, efficient and decentralized generation of energy companies emerging. They're smaller scale projects. You know, these are not multi-gigawatt projects typically, except in the data center market where they're really getting going at that kind of scale. The kind of answer to the question is in a Substack I wrote about 3-4 months ago. I called it the perfect problem. Like extraction companies are brilliant at what they do. They happen to waste 10% of the energy. It's the most efficient economic outcome, but it's bad for the energy system. The generators I told you about, the gas energy systems, they're paid to generate electricity. They're doing an amazing job. They're being as efficient as they can. They're just dumping half their energy in the atmosphere. They're, so to speak, perfect businesses, but from an energy system impact perspective, it makes no sense. So what we have is two things. We have a policy deficit where governments need to look at ways in which they can incentivize decentralized generation and efficiency in buildings. Sadly, we've started to see policies like this being unwound here, like the Energy Star programs.
Right.
And then, you know, I think the next piece of it is, and this is the biggest piece, I'm afraid, is that this is all down to the user. Like, you know, I'm here, this isn't all really about the governmental supply. Energy is used in buildings, industry, and transport. And I'll ask you one question, you can ask me, you can tell me what the answer is. Have you ever heard of a company with a chief energy officer? A chief energy officer. I don't mean a chief investment, technology.
No, I know.
And think about how essential energy is to running a business. You know, in the data centers, you measure them in megawatts.
But I will say, I have talked with chief sustainability officers where they are looking at, like, that certainly comes into their purview and is part of it in terms of the running of the company.
Correct. So that's within a mandate.
But I see what you're saying.
The critical function that energy has. And the last point I'll make on this, which links into the supply and demand side, you know, we've seen massive nationwide grid outages. So when we talk about the grid and reliance on the grid, not only is decentralized energy cheaper, cleaner, more reliable than the grid, but what happens if the grid fails? Well, it doesn't fail. People say, well, wait, hang on. You know, Iberia, the entire Iberian Peninsula went dark a few weeks ago. Heathrow Airport went dark 2 months ago. It had no on-site generation. Not only could it have been saving money and carbon, but if the grid went down, it would not have mattered. Chile failed on the 25th of February. The 90% of the grid went down. So what I'm talking about isn't just about lower costs and lower carbon. It's about resilience. This is the critical thing. We now live in a world where it's not if the grid is going to fail, it's when and where.
Reliability.
So whatever merit you want to pick, I want to be safe and secure. I want lower cost energy and I want lower carbon energy, then decentralization has to be the strategic answer to your question.
I always love when you come in. I mean, such an important part of kind of our world and trying to think about where it goes next. Thank you so much.
Thank you so much for having me.
Always, always. Jonathan Maxwell, founder and CEO of SDCL. As we've told you, it stands for Sustainable Development Capital LLP, and they've got about $2 billion in assets under management. His book, Jonathan wrote, The Edge, How Competition for Resources is Pushing the World and Its Climate to the Brink and What We Can Do About It. Very, very timely conversation. Jonathan, thank you.
Hey, speaking of timely conversations, I want to take a look at the markets right now. The S&P 500 down 1.6% on the day today. The Dow falling 1.9%. The NASDAQ Composite falling 1.4%. Look at that, Carol Master. 18 stocks moved higher in the S&P 500, 485 to the downside. All about the weak 20-year auction that we saw just about 1 o'clock p.m., and then we saw stocks take a leg lower.
Very clear move. Like we get it when there's a clear catalyst. Let's get to it and see what Eric Weiner has to say, what he's been watching. Bloomberg News senior editor, Equities America, back with us on today's trade. Hey, Eric, we've had, I feel like over the last week and a half, we've had these days where things happen and we all keep saying, it's boring. Today really wasn't necessarily boring, was it? Or was it?
No, but I wouldn't call it boring. It was interesting that up until the auction, I believe, I forget the exact number, but there were like 80 stocks up. The market really had a poor tone all day. But the stocks that were up, and Alphabet ended up, but the stocks that were up were these, big tech stocks that kind of hold things in place. And then the 20-year auction happened, and bam, the 30-year yield jumped over. Well, it was over 5, but it jumped well over 5. The 10-year, which is what everybody's looking at, climbed close to or around 4.6. And the fear is that if that goes to 5, that's where things get very, very dicey for the stock market. And so everything sold off. The whole market basically turned red, and we just shot down.
Is this the bond market getting yippy, Eric, to borrow a phrase from President Trump in April?
Oh, yeah. Everything is sort of right now is on tender hooks. It really does feel that way. Like the question immediately became, is this the thing? Because everybody is waiting for a thing to sort of trigger what is expected to be at least a retracing down of what we gained over the last month. So we're wondering, does this sort of set things off? But it's hard to know because usually it's something innocuous, like a 20-year auction that does it, but you only spot it in retrospect.
You know what? If we look at the 10-year yield, it's at 4.59 right now. And that's actually higher was it Michael McKenzie who pointed this out, Carol, to us earlier? I think it was Michael McKenzie.
Yeah.
That's higher than what it was back on the 10th of April when we were looking at, in the post of so-called Liberation Day, we were looking at the bond market being, quote, yippy.
We're getting notes about the possibility of it going to 5. Which, wow. And what that would mean for the market. And it's obviously not good is the answer. But the real point is we were not talking about that very long ago. If that keeps up, the trend in the stock market is in peril. And really, this has been set up by retail investors who have been buying all along. The question now is, at what point do things fall enough for institutional guys to step in and dip buy, and will they do that? And really, we're waiting for the signals on that.
Come on, Eric, can't be all that bad. Bitcoin hit a record. Life is good.
Google did well. Alphabet did really well.
Alphabet did really, really well. You're absolutely right. There are fundamental stories. I found some gainers, some big-time gainers in today's trade. Having said that, I guess the question is, and I think about, we were talking with, I can't remember which guest it was, but it was basically the idea that all roads lead back to the White House. And what we see how much the president's going to press on this massive spending and tax bill. You know, do they take steps to say, wait a minute? I mean, we talked with Eric Wasson up on Capitol Hill. He said, this is it's going to add a bunch to the U.S. deficit. This isn't about reduction in the deficit. So does the president go back? Does Johnson go back, Speaker Johnson, and say, we gotta rework this because investors aren't happy? I mean, do they do that?
I don't know if they can. I mean, if you look at the history of presidencies, the idea of cutting taxes and then doing anything with spending means that you really have very little room to go. And he wants to cut taxes very badly, and that was considered stimulative until it brought our debt into question. Now, I don't know that the market corrects this. I do think that they may correct it down the road, but we seem to be slamming into a situation where this could cause a lot of problems with it already has with our credit rating, but with just the stability of the dollar, the stability of the bond market, and that all flows over into the equity market. That's where the scoreboard will show up.
It's pretty remarkable to see this because what's happening in the bond market is, I don't know, it caught me by surprise today. Like, why is this auction weak, but others of late haven't been? Like, what was it about today that, was it, as we've been talking about, Eric, the spending bill in Washington? Is that what it is?
You're like, who cares about 20-year?
It's
like
a
we were saying,
First of all,
we were saying before earlier, like, who writes about 20-year auctions, right? It's not like, right?
It's really an innocuous thing, but that's kind of the point. It's a longer term auction, so you're looking at between the 10 and the 30. But really, it's the moment. The moment is right as we are talking about the stability of debt and our ability to pay things off. We come into an auction and buyers say, you're going to have to give us a little bit more in order for us to soak up this demand. And that right there tells you that the market doesn't necessarily believe in the U.S. economy and the U.S. government, however you want to put it. It doesn't believe in the U.S. the way that it did a week ago. And that is what's scaring investors is like, well, if this is where we are a week from last, where will we be a week from today?
Yeah, I mean, yeah. $1 trillion question, right? Yeah, no, this is the thing that has plagued investors, right? The uncertainty that keeps kind of, chipping away. And there's a point where you're like, I'm out. Like we had a fund manager earlier whose cash position was up around 14%. Typically it's about 4 or 5, I think he said, or 3 or 4.
Yeah, Sandy Villery.
Yeah, so just kind of waiting for things to settle. Hey, Eric, always good when we can kind of wrap up with you on the markets. Eric Weiner, of course, folks, joining us on this Wednesday. He's Bloomberg News Senior Editor, Equities Americas. Always check out he and the team's work. You can find it on the Bloomberg and at Bloomberg.com.
Let's talk CFOs, Carol.
Yeah, actually, we're building on something. We actually talked to a CFO earlier.
We did. We spoke to Matt Skarupa. He's CFO over at Duolingo. Chief Financial Officers now play a critical role in shaping corporate strategy and positioning organizations to meet future challenges. Bloomberg's monthly program is called Chief Future Officer, and it profiles these leaders and explores the impact that they're making on their companies and their industries.
Listen, what I will say about this series, what's really cool is you've seen it since the great financial crisis. The CFO became critical in keeping companies alive and figuring out how to manage and deal with their balance sheets. We saw that through COVID. And you see increasingly the CFO so entrenched in the C-suite and working side by side with the CEO in terms of figuring out strategy, how to spend money, what makes sense for the company. And this is why this series is so cool. And it's great to see you actually, talk with this CFO in particular, because this is a company that's been on fire.
Yeah, so tonight, the most recent episodes of CFO, Chief Future Officer, premieres. It features CFO of Duolingo, Matt Skarupa. We spoke with him earlier today. I hosted this episode. Matt's positioned the world's most popular language learning app for a new phase of growth powered by AI.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook. Take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO. It's fantastic, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it. And so far, we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. And after that, I'm never doing that again.
That was a clip from tonight's episode of Chief Future Officer, featuring Duolingo CEO Luis Von Ahn, as well as Duolingo CFO Matt Scarupa.
And this is why I go back to what's cool about this series. The CFO, Chief Future Officer, is the CEO is always featured as well, right? I've done a couple, you've done a couple. And what's interesting is it shows the relationship between the two and how they are working hand in hand. And I will, again, just reiterate, going back to the great financial crisis, you needed your CFO to understand financially where your balance sheet was, what was needed to kind of keep the company going. Happened during COVID too, and these guys became so much more than just someone who pops on an earnings call or throws, does the kind of all the financial sheets, if you will, for a company.
Well, one thing that's interesting about this one is the way that it's diving first into AI and the way that the CFO and the CEO are thinking about AI. Speaking of thinking about AI, Luis Von Ahn was the recipient in the 2000s, Carol, of the MacArthur Fellowship. This is also known as the Genius Grant.
Yeah.
He was a computer science guy at Carnegie Mellon, and he won it as a result of the work that he was doing at that time in AI, back in like 2007-ish.
Yeah.
He's been thinking about this stuff for 20 years, whereas many people have just been thinking about it for like 2 or 3 years. So this, I think it's fair to say at this point, is an AI-first company, and they've gotten in hot water recently as a result of it, but we dive into that a little bit in the episode.
Yeah, really. What was the thing that struck you the most about this?
I think the thing that struck me the most was the culture of the company and the way that the CFO and the CEO are trying to build this culture. You can see it with the way they market, see it with the way that they communicate on social media. Literally, the word unhinged is in their handbook, their cultural handbook. It's also a company that every year, Carol, takes everybody in the company to Mexico for a week for a retreat. You don't have to go, but it's in the handbook.
Why would you not go?
Why would you not go? I don't know. I would obviously go.
Where in Mexico?
I don't know exactly where, but they go to the same place. But that just shows that, the way that this company is, it's based in Pittsburgh.
Yeah.
It's not in Silicon Valley. There are a lot of unique aspects of the culture.
Very cool stuff. Hey, folks, we're headed for a break. A reminder.
9:30 tonight. 9:30. Check it out.
On Bloomberg Television. Be sure to catch it. Really cool company. Really cool conversation with Tim and the CFO of Duolingo. Stocks on the move. That's next.
This is Bloomberg Business Week Daily with Carol Massar and Tim Stenovec on Bloomberg Radio.
Hi, Carol Massar.
It's just kind of fast and furious today.
It is. We've taken a lot of we haven't taken a lot of breaks.
No, we're
I have a package of snacks that I haven't been able to eat.
Like that's different from any other day?
That I haven't been able to eat. Usually I can eat them during a break.
But
I opened this.
You could eat sandwiches.
I was about to put a cashew in my mouth.
Don't do it. Don't do it.
And then I was like, then Ari said in my ear,
Go.
I can't put the cashew in my mouth then.
Just a reminder, 1.6% lower on the S&P 500 today, just off its lows of the session. Dow down 1.9%, 816 points to the downside, just finishing off its lows. NASDAQ 100 down about 1.3%, off its lows, but definitely off its highs. All of them, we saw risk-off trade across the board. This as yields moved up all along the Treasury curve. And again, concern on Wall Street about the budget deficit, the ballooning budget deficit, especially as that big spending and tax measure makes its way around Congress.
I'm Tim Stenovec along with Carol Massar. Let's take a look at some stocks on the move today. Bloomberg News cross-asset reporter Isabel Lee is with us right now. You had a lot to choose from, Isabel.
A lot, so that was tough, but I'm going in strong with Lowe's, so it's edging lower by 2%. It edged lower by 2%. We are in market close now. So I have a comparable sales beating expectations last quarter, and that's really as shoppers maintained home spending despite this macroeconomic environment and just weakening consumer sentiment in general. But they did see a 1.7% dip in comparable sales, which came amid bad weather. So I think that's what soured sentiment a little bit. So what does this tell us? That American shoppers are really still pursuing smaller ones, even though they're deferring bigger projects. And I can attest to pursuing smaller ones. I hung some little frames in my home with a sticky tape because I'm a renter. But honestly, results of Lowe's and Home Depot, the main competitors, suggest that U.S. consumers really have yet to make any changes to their spending.
You know, I feel like we saw this in so many names today because we saw this stock kicking around a bit, higher at one point. Down
Just at 1 point. And then, yes, you're right.
But finishing the day down about 1.7% here, right?
What's the stock got to do to get
love?
Yeah,
well,
get some love.
I don't know, but I agree with you. Like, I'm going to buy some plants. Like those are the little things you do. And do some gardening.
Some soil.
But no kitchen renovation or anything like that.
I don't know. Waiting for those prices still to come down off the pandemic. What do you need?
I need gloves to pull poison ivy away from a fence.
Are you serious?
Yeah.
Did you go buy them?
No, I'm going to buy them, but I asked ChatGPT if it was poison ivy. I took pictures.
And?
ChatGPT said it was. I didn't believe ChatGPT, so I uploaded the same pictures to Claude.
Be very careful as you do this, though, because you don't want it, like, if stuff moves around.
Oh, I fully plan on trying to get somebody else to do this in my life.
Oh, are you?
Yeah. This is the type of thing where I will gladly pay somebody
You're not
to...
giving a white suit from head to toe?
No, I've had some bad experiences with poison oak in my past, so I have no interest in...
But the poison ivy didn't even strike me. What struck me was that you have a fence. So that's a low-key flex that you have a fence.
Oh. All right. All right, there it is.
All right, let's go to Moderna.
This one is, we saw a big fall today. The stock closed lower by nearly 8%. So Moderna said it voluntarily withdrew its application for regulatory approval for its combination COVID and flu shot for people over 50 years old. Moderna said it made the decision after consulting with the FDA. It did add that it plans to resubmit the application later this year. So this is a setback for the company because they've really been trying to boost their strategy because no one is really taking COVID shots anymore, but everyone still takes flu shot. I'm lucky. We're all lucky. We work at a company like Bloomberg, so when I get the email, time to take your flu shot, I voluntarily just go down. But I actually haven't taken a COVID shot, so they thought this 2-in-1 thing would actually result to higher uptick. But they did see the potential approval in 2026. So actually, when I first read this, I was like, a 2-in-1 shot, I would definitely consider that.
What's interesting, too, is we've seen the vaccine makers on a tear.
Yes.
Like this one was up 3 days in a row, a total of, I think, about 18% here between Friday and Tuesday, because some of the things that were coming down right from the government that, okay, maybe it wasn't going to be so onerous in terms of vaccines, that they were going to approve some, or the testing wasn't so complicated to get things through. So interesting to see that switcheroo today and the pressure.
Yeah, but I think it's a step back to the broader plan. Maybe investors really cling on to that hope. I mean, you have to admit it's kind of creative, a 2-in-1 shot.
Yeah, exactly. I'll take it.
More retail is what I want to talk about.
Yeah.
So VF Corp
Because you
down
shop here?
Do you shop here?
Or their brands?
They own some. Let's see. What do they own?
I think Timberlands and Vans, VF Corp.
Vans, okay.
I don't wear those,
North
but
Face
many
too.
people do. Yes, North Face. So they're
Yeah.
down by 16%. The company projected a bigger than expected loss, and they warned investors that they've really been rushing to beat the 90-day window of tariff pauses from the Trump administration. That's something around July 8th, I think. Somewhere in July. Who knows if we'll see another extension or even... I don't know actually what we'll see, but so far this year, the stock has already declined more than 30%, and that's really as the company